The European market opened a minute ago until the start of cash equity trading. I'm Tom McKenzie in London. Here are your top stories. Countdown to Powell. Jackson Hole in focus today with the Fed under pressure on how it plans to temper inflation. Tech relief progress in the dispute over Chinese listings in the US boosts stocks. Plus, no let-up. UK regulator Ofgem triples the price of winter for many households as Europe's energy ministers meet to discuss a solution to the crisis. So it is that day, of course, when we are going to get that speech from Jay Powell. The drumbeat leading up to this, the hawkish commentary from the likes of Bullard and, of course, Esther over in Wyoming. But the market's apparently looking through this. You saw gains on Wall Street and Europe yesterday. There's a bit of divergence when it comes to the future stateside and what's happening here in Europe so far. We'll see how things open with the futures pointing up in the European space, but US futures pointing lower. You do have yields as well across from the 2s to the 10s stateside, edging up around 2 basis points. Currently, the FTSE 100 gaining 0.2%, up 17 or 18 points. Of course, we continue to monitor what's happening in the energy space. We'll break that story down for you. But James Bullard coming out and saying that he favours front-loading, and Esther George saying you could be above 4%, possibly, as the Fed tries to get inflation down. We'll see if Jay Powell echoes any of those thoughts. Bullard also saying that maybe the markets are underestimating the need for the Fed to stay longer, to pull this inflation down. There will be a stickiness, possibly, that will hang on longer, and there'll be further action to address that. The CAC growing over in France, getting 0.6%. The Spanish IBEX up 39 points. Let's switch it over, see how things are playing out across asset. I talked about the futures stateside diverging from what we're seeing here in Europe, and that picture continues down 0.1%. You saw gains of about 1.4% on the S&P yesterday, about 1.7% on the Nasdaq futures. So it was a pretty solid day across US markets. Euro dollar currently back below parity, down 0.2%. The 10-year, I said there was a move higher in yields. You're seeing that now, 3 basis points on the benchmark, 3.05. Brent up again, currently up 1.3%, $100 a barrel on Brent. Let's get over then to Bloomberg M Live Managing Editor Mark Cudmore, who of course is zeroing in on what's happening in Jackson Hole. Mark, you are not only looking at Jackson Hole, you're looking to belong at Jackson Hole.
Yeah, absolutely, Tom. I'm auditioning to be flown over next year to actually attend the conference myself. I really hope I will be there. I got this hat specially for the occasion. So I just wanted to talk about the idea of what we're pricing into Jackson Hole, because I think there has been this real narrative recently that suddenly the markets are expecting a really, really hawkish message. And actually, if you look at kind of euro-dollar pricing over the last couple of months, this is DEC euro-dollar. There's not really been any change in yields for about 2 months. So we're still around this 4% yield end of year. So basically, yeah, rates have priced in a little bit more hawkish this month. In fact, since the day after the last Fed meeting, there's an extra 8 basis points priced in for September. Just 8 basis points. So it's hardly really dramatic. There's a little bit more room for a dovish surprise than a hawkish surprise going to this weekend. But really, the market is very, very split in positioning, and it can go either way. And I want to draw it to the next bit, which is dollar, because everyone's been talking about, hey, euro-dollar cable, they've collapsed so far. We can't really sell them down here. Well, look, this is CFTC positioning of euro-dollar over the last 10 years. Now, the last data point is from last Friday, which actually brings us to the data up to last Tuesday. We will get another data point today. So, yeah, it's about 10 days old. I'm sure the market's got shorter over the last 10 days, given how the market's traded. But really, we're right in the middle of the range. We've got nowhere near the extremes of euro bearishness. The yellow line is the zero mark, the flat positioning. We're nowhere near where we were in 2019 or all during the mid-2000s. And again, it's the same picture pressure on cable, where you may think, Tom, that there is this kind of gloominess around. Everyone's extreme bearish the pound. Certainly I am quite bearish the pound, and we've talked to many guests at that. But the positioning shows that actually over the last couple of months, people were closing short pound positions, maybe because of that big move higher in yields. And again, the market is short. This is the zero line here, but hardly extremely short. Nothing like post-Brexit. Nothing like even when we were coming into negotiating the end of the Brexit deal. So I think the big takeaway is positioning is not too extreme in this market. Yes, the market is slightly ready for a hawkish message. Yes, the market is slightly long dollar, but not extreme. So if we do get a hawkish message, the market will really run with it.
Mark, the big takeaway is the Headwear Award goes to you. Mark Cudmore, thank you very much indeed. Bloomberg MLive Managing Editor, breaking down what to look ahead to and what to focus in on when it comes to FX and, of course, fixed income as well, ahead of that speech by Jay Pound, sporting the fantastic Stetson ahead of that speech in Wyoming. Let's bring in some market guests then to break this down further. The financial world, of course, counting down to that speech. FOMC member Esther George told Bloomberg that it is important to clarify the destination that rates are heading to.
We have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts. Seems a bit remarkable to me. I think we will have to hold
over 4%.
It could be well over. It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
Okay, Esther George there. We are joined now by Joe Little, Global Chief Strategist at HSBC Global Asset Management, and Bloomberg's Christine Aquino covering FX rates and EM for us. Christine, let's start with you. The market reaction. We've heard the hawkish commentary from Bullard and Esther George, and the market's continuing to look through this.
Absolutely, Tom. I think they really are looking past that and waiting for the big man himself, Jay Powell, because that really will be the determinant of Fed policy moving forward and the signals that he's going to give there. And, it's very interesting, though, the commentary, because a lot of these officials are emphasizing the direction is higher, but they can't quite seem to specify how high it's going to get. And, we know it's tricky, but that is the sort of specificity at this point in time that markets are looking for. And so there's a risk that if Powell doesn't deliver that there is room for disappointment here.
Joe, do you agree with that? Let's bring you in at this point. Is there a potential, what is the potential for a negative market shock on the back of Jackson Hole?
Yeah, hi, Tom. Good morning. Look, I think we're in an environment where looking for decisive forward guidance is probably an unreasonable expectation to have, given the uncertainties of the situation, given the pressures on the Fed, from the data side, on the political side. So I think I tend to agree that it's not appropriate to think too specifically about the scenario for rates. The Fed are very much in a hike and see approach at this juncture. And that might mean that we get to the end of the year, 325, 350 on the Fed funds rate. And they're very much going to be data dependent and take the data as it comes in the early part of the new year, exactly like Mrs. George said.
Yeah, and of course, we're going to get the CPI print out for the month of August leading into that September decision. James Bullard saying that the markets are really not adjusting to what could be a more persistent inflationary picture, that maybe that's not being priced in by the markets at this point. Would you agree with that view?
Yeah, the assumption that investors have, that we see across a range of instruments in the fixed income space and also looking at risk asset classes, is an assumption that we are going to see a hiking cycle through to year end, which is largely clear and understood. And then into next year, we're looking at the market is pricing a scenario of flat rates and then rate cuts toward the end of the year in the second half of 2023. The overriding assumption within that is the notion that inflation control will be reestablished. If we end up having to experience a situation where inflation is a lot more persistent, where the economic cycle is a lot more turbulent and volatile, then that creates a different scenario for the markets to digest and think about. And I tend to agree that that's not really reflected in how either fixed income or risk markets are pricing themselves at the moment. I do think that is the risk. That's the direction of our risk, the balance of risks to be focused on, because the reality is moving from a 9% CPI to a 5% CPI is relatively straightforward, given the developments that we're seeing in China, given the developments that we're seeing in commodity prices. The hard work is moving from 5% to 2% on the CPI and really reestablishing that inflation control. And I think it's a mistake to see the inflation data beginning to turn, to see things heading back toward mid-single digits, and then to declare victory. The Fed won't be falling into that trap, but I think potentially market participants may be thinking along those lines. So that's the danger.
Yeah, Joe, that's really interesting. 9 to 5, relatively easy. 5 back down to 2. That's what becomes really problematic. And that kind of brings us back to the tools that the Fed has at their disposal, Christine. We'll bring you back on this. 50, 75, the markets are split on this when it comes to September. Is it the number, is it the size of the hike that's more important, or is it the quantitative tightening that's going to be stepping up as well in the weeks ahead? What is most consequential for price action going forward?
Well, Tom, I mean, the focus obviously in rates markets right now is very much how much the Fed is going to be delivering, or how much more, apart from the 200 plus basis points that we've already seen. But yeah, you're absolutely right. I think QT is something that has been on the back burner, and I think that's where the underestimation from markets, at least from the fixed income side of things, probably lies, is the fact that there is also this additional policy lever that the Fed really hasn't quite wielded to its full extent. And once they do, once that gets going underway in earnest, I think that does have the potential to, again, further drive up those yields, even though we've already seen that adjustment just from the reaction to the rate hike pricing alone. So imagine the impact of QT also feeding through to markets. I think that's going to be, yeah, very interesting potential upward momentum that we're going to be getting from that.
Okay, 337 currently on the US 2-year. That's a move higher of 1 basis point. US 10-year 3.05, a move higher of 3 basis points. Christine Aquino, of course, across all things in terms of key market themes for us. Thank you very much indeed. Joe Little, Global Chief Strategist at HSBC Global Asset Management, pleased to say, is staying with us. Get more of his thoughts and analysis after the break. And you can catch, of course, special coverage of the Jackson Hole Symposium right here on Bloomberg TV, where we will be hearing from Fed officials. Coming up, leaders across Europe face increased calls to take action as soaring energy prices add to the unfolding crisis. That is next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
A weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
welcome back to the Open. We are 12, almost 13 minutes into the European trading day. You are seeing gains of 0.5% across the benchmark ahead, of course, of that Jay Powell speech. Is he going to lay it down for the markets amid these looser, tightening, at least financial conditions, or are we just going to hear more of the same from the head of the Fed? Let's check in on some of the individual corporate stories. We have some deal making that's going on, but also some updates around a legal case involving some of the drug makers here, GSK in focus for that one. But let's start with Micro Focus. Look at that, gains of 90% on the back of some news that OpenText will buy this company for 532 pence a share. That's a valuation of about $6 billion US. That's almost double the closing price of yesterday. And you can see a massive move higher in that London listed stock. GSK up 2%, almost 2% on the back of news that there's been a ruling, at least initial ruling in Florida, which may mean that a settlement they face around their Zantac drug could be significantly lower than previous thought. SFK, this is a Swedish maker of bearings and seals. News that Sevian Capital is raising its stake to 5.5%, saying that the value is not reflected in the share price of this company. You're seeing a jump there of a little over 5%. Now, pressure is mounting on European leaders as energy prices soar to levels last seen during the early weeks of Russia's invasion of Ukraine. Let's bring in then Bloomberg's Stephen Straczynski in Singapore, who works through the granularity of this for us. Stephen, how much pressure are EU leaders under at this point, and what are the actions that they can take beyond going to places like Algeria and signing longer-term deals?
You know, they've never been under this much pressure before when it comes to the energy market. You know, you have natural gas prices, like you said, near the highest level since the war began, closing at a record high level yesterday. You have German power at a record high. You have French power at a record high. You have many other countries facing with seasonally high power prices. And this is starting to already, you know, insert itself into power bills. You've seen the UK is going to have to significantly increase their power bill from October under Oxfam. You have many different countries dealing with issues where you have energy poverty, where households are unable to pay their bills. So this isn't just an economic issue. This is a political issue, because if you're the government in Germany, in France, in the EU in general, and you want to maintain your power, people aren't going to be happy. You know, they're going to vote with their wallets. They're going to see what's happening, and they're not going to want you in power if they're unable to pay their power bills. So that is the issue that they're facing at the moment.
And we are hearing as well that EU leaders may be meeting or holding an emergency meeting, Stephen, to discuss this crisis. What are we expecting from that?
Yeah, so the Czech Republic, they've got the rotating presidency on EU. They are looking to bring together some sort of meeting. It's likely they're going to propose some sort of price cap. Now, that isn't necessarily a popular deal across the board. France, for example, has pushed back against that because they don't think that their system, their grid, the way that their power is sold requires a price cap, and they'd rather allow it to maintain what it's doing and let the system continue as planned. But there are a lot of other governments that are under pressure. They're looking at ways, can we remove levies? Can we try to put some sort of bailout to provide some cushion for consumers? There are a lot of different options and levers, but at the moment, it looks like a lot of eyeballs will be on whether some sort of price cap is discussed or considered.
Okay, we'll be watching to see if there is more relief for households and businesses coming through on the back of that emergency meeting. Bloomberg's Stephen Straczynski, thank you for walking us through some of the key themes around the energy space this morning. Let's bring back in Joe Little, Global Chief Strategist at HSBC Global Asset Management. Joe, I have a question as to whether or not really equity markets in Europe have fully priced this energy shock. I'm just looking back over the last 30 days or so, at least since mid-June, so a little beyond that, and you're seeing gains of about 8% across the European benchmark, despite the fact that we are getting fresh rallies almost on a daily basis when it comes to gas prices and energy across Europe. Is this still underpriced?
Well, look, it's a good question, Tom, in the context that we find ourselves in, because as your correspondent alluded to, the spike that we've seen in natural gas prices has really been dramatic and acute. I mean, if you were worried about a European recession at the start of the summer, you're sort of petrified about it now. Natural gas prices on the Dutch contract, which is the one we tend to focus on, are up 50, 60% in August alone. We're at 13 times normal levels. That's an acute drag on industrial production, industrial activity. It hammers confidence. It really dramatically squeezes household incomes. So the likelihood of a European recession now seems, a certainty for the second half of the year, and we're looking for policy support. European equities, however, are already trading on a significant valuation discount relative to other global equity markets. So there is at least something in the price reflecting the challenges around the profit outlook and the risk of profit recession in Europe.
Joe, when you look beyond Europe, what are the opportunities in this volatile environment with the uncertainty around the Fed and that likelihood, as you say, of a recession here in Europe? But what could you be adding to your portfolios at this point?
Well, recession risk is very much everywhere. The activity data in Asia this week has been disappointing, and we know the story in the US already. We're just sort of watching the data on the labor market and the corporate profit side as the next leg of that story in terms of how it proceeds through the cyclical indicators. But look, I think you've got to be realistic at this juncture. We've got some support for the market at the low levels that we've put in already earlier this year. We've seen a decent sell-off in risk assets, decent sell-off in fixed income markets during the course of the year. There's a lot of pessimism already around there, but the uncertainty around recession and the macro outlook, profits recession risk, liquidity being drained from the situation puts a real dampener on the outlook for investment markets. We expect a bit of a range-bound market, quite a choppy phase to continue for the time being. And that might be the kind of environment where you don't really want to be making big, broad brush bets in your asset allocation strategy. So being a bit more granular, being a bit more specific, looking a bit more at regional allocations does make sense. And one area, Tom, if I can squeeze in the comment, that we are interested in a lot is some of the behavior that we see, particularly in Asian markets. Asian risk markets haven't had the easiest time of it across the board. But if we look at, for example, the behavior of the Chinese stock market versus global stocks, it looks highly uncorrelated now. That's very unusual in the typical pattern of how equity markets behave. We usually think of equity markets all rising together or falling together, but the Chinese equity market looks completely decoupled now. And if we look across the Asia region, we see really strong performance in some of the South Asian markets, notably India, relative to China. The two markets are sort of orthogonal. And behaving very much opposite to each other during the recent few months. So there are some opportunities for regional allocation, and there are some opportunities, really fascinatingly, for diversification within a global equity portfolio. So it's those more granular bets, more regional allocations that I think we're focusing on at the moment. And the broad sense that we have is that we're still in a bit of a choppy, range-bound environment, which is sort of what we've been seeing already during the course of much of the summer.
Okay, very interesting indeed, that decoupling between China and the rest of the world when it comes to the equity market performance, and maybe some upside, further upside in India. The opportunities possibly in Asia as we fret, of course, about recession risks here in Europe. Joe Little, Global Chief Strategist at HSBC Global Asset Management. Thank you for that analysis. Coming up, talks to avoid the delisting of Chinese companies in the US advance on the back of a plan to audit in Hong Kong. They are making progress. We've got the details next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
To be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
Happy Friday, welcome back to the Open. We are 24 minutes into the European trading day. Let's get back to what's happening then in terms of China and the US. Talks between Beijing and Washington to avoid the delisting of about 200 companies from New York exchanges. Well, those talks are moving forward. Officials are discussing a plan to let US inspectors travel to Hong Kong to review audit documents of Chinese businesses. For more, we are joined by Bloomberg's Sophia Horta-Acosta out of Hong Kong. Sophia, does this make a US-China deal on ADRs more likely then?
Morning, Tom. Well, look at the move in Hang Seng Tech Index yesterday, plus 6%. There was clearly a short squeeze there, but investors are hopeful that this is finally it. We've had so many kind of developments in the past few months, so many reports that the talks are moving forward, but every time there seems to be a concession from the Chinese side, the US regulators push back. So what we're watching out for now, Tom, is what will the SEC say? We know that Gary Gensler has been really pushing a hard line on this. So is this concession from China something that the US is ready to accept? That is the key question. And everyone I'm talking to in Hong Kong right now is waiting with bated breath for something, some sign from the US that they would accept this.
Very interesting. So the ball is firmly back in the court of the US regulators, and we'll see how they respond. What are investors and analysts saying more broadly about these developments?
So what was interesting is that we had that big move in the run-up to the reports, but today the Hang Seng Tech Index is actually not particularly excited. There seems to be still a little bit of caution, still a lot of skepticism in the market, and you can really see that the short positions are unraveling, but people aren't really ready to go along this market. There's so much uncertainty, and the traders who wanted to keep their exposure to Chinese tech, they've already bought the Hong Kong listings of Alibaba, of these dual-listed companies. So this is actually good for Hong Kong. This shows if it turns out to be true, and if the US does follow through on this, it shows that Hong Kong's future as a financial hub is relevant. It's still that gateway between the US and China.
Okay, fascinating development. Sophia Horta-Acosta out of Hong Kong. Thank you. Our chief China markets correspondent. Gains on the HS Tech of 0.6%. Coming up, UK household energy bills are set to soar once again as they're hit with a massive rise in the price cap. We've got more on that story next. European markets gaining 0.5%. Stay with us. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Countdown to Powell. Jackson Hole in focus today with the Fed under pressure on how it plans to temper inflation. Tech relief progress in the dispute over Chinese listings in the US boost stocks. Plus, no let-up. UK regulator Ofgem triples the price of winter for many households as Europe's energy ministers meet to discuss a solution to the crisis. So, will Jay Powell, as many of our guests have expected, push back with a more hawkish stance, push back on the market positioning for a pivot in 2023? James Bullard saying he prefers to front-load hikes, suggesting that maybe 75 basis points for him is in play in September. Of course, some important data coming through before that decision. Esther Jaws saying that the rate may need to get above 4% for some time to bring inflation down. Of course, the dot plot's having at 3.75 by the end of the year. You're currently at around 2.3% in terms of those rates in the US. A benchmark gains of 0.4% here in Europe. We did have Ofgem and that announcement, of course, 7 a.m. Local time. Bills now increasing to around £3,500 here in the UK. Just a reminder of that incredible squeeze on households, but businesses as well. The FTSE 100 gaining 0.5% despite that announcement. The DAX up 0.6 or 83 points. Let's switch it over, see how things are playing out across these sectors. Energy and commodities gaining this morning. Yields, by the way, from 2s to 10s are up in terms of what you're seeing across the benchmark and that yield space stateside. Basic resources getting 1.6%. Tech up 1.4%. We had that optimism coming through in terms of the moves closer to a deal between the US and China. We're not there yet, but they have had some movements, and that possibly is providing some relief to the tech sector. Certainly you see that playing through in terms of Asian shares and Chinese tech listed in Hong Kong. Media currently down. Food and beverage also lower by between 0.1 and 0.7%. That's what's happening across your sectors 30 minutes into the session this Friday. Let's get back then to that energy squeeze and the pressure on UK households. They will now pay almost triple the price to heat their homes this winter compared with a year ago. That is after the industry regulator Ofgem raised the energy price cap on the back of soaring gas prices. We're joined now by Dave Manzani, Managing Director at Aurora Energy Research and former Director for Energy Security at the UK Government's Department for Business, Energy and Industrial Strategy. Dan, good morning. Great to have you on the show to get your insights, particularly given that government experience. Let me start with this. Is Ofgem fit for purpose at this point?
Well, yes, I don't think Ofgem, whatever criticisms people have of it as a regulator, is to blame for the price cap rising. That's a direct read across from higher wholesale gas prices, which are being experienced all around the world. and the price cap basically passes that through to consumers with a bit of a lag. What we're seeing here is the cost of using gas for heating and in power, and a conflict with Russia and Ukraine driving those prices up.
So Dan, if it's not Ofgem, and I understand that rationale, then is there at least a case for a rewiring of the UK energy market?
So I think it's very important to be careful about important steps we should take in the short run to deal with what is an absolutely huge winter crisis, and longer term reforms. We're going through a massive change in energy to a world in which we have decarbonised power, for example, and that we use power for more things like heating that will reduce our gas dependence. And there are long-term debates about the best structure for those markets. But I think trying to dive into very complicated reforms to, for example, wholesale electricity markets is unlikely to give the kind of relief that's needed to households and businesses in the very short run. There, I think we need to be looking at measures that help people use less gas, whether that's energy efficiency or by using less in the power sector by building out more wind power. But also, frankly, in the short run, it's about smoothing out some of the costs over a longer time period. Consumers are likely to be spending up to £100 billion over this financial year on energy. As you say, that's up from, up by nearly 65 billion. You can't absorb that on household balance sheets, particularly the poorest. There's going to have to be action to spread that out over a longer time period.
I mean, absolutely. Well, there's some analysis suggesting that more than 50% of UK households will be in fuel poverty next year. That's just not sustainable. Households will not be able to afford these price rises. And many will be looking with befuddlement at what's happening in Germany, where households are better protected from these rises than we are here in the UK, despite the fact that we have actually access to natural gas. Does there need to be more direct intervention from the government?
Yes, I mean, I think if you look at previous conflicts where there have been huge spikes in costs, governments have acted to spread that cost out over a longer time period. And I think that's what needs to happen. There are different ways of doing it, of course. You could look at the kind of measures that some in the industry have suggested, which is a kind of tariff deficit securitization. So you have a fund that money's paid into, maybe raised from private sources and then paid back over a longer time frame. That's using private markets to finance the short-term deficit. Or you could use the government balance sheet and repay it through future taxes, whether that's on carbon or on income to make it more progressive. But you've got to act. I don't think you can expect the poorest households to absorb the cost of a war in Ukraine.
So that's on the need to act to protect those households. What about business, Dan? Because, of course, they don't benefit from the price cap. It's eye-watering as it is for households. But when it comes to businesses, there is no cap.
No, and there's a double hit here. Obviously, there's the direct hit, and it's particularly important for energy-intensive industries who will see their costs, a significant proportion of their costs rise considerably. Some of them may be able to pass that on, but of course that drives higher inflation in things like steel and other commodities that are energy intensive to produce. But the second half of this hit is, of course, if households don't have any money to spend, indeed if they're driven into further debt in order to fund basic essentials, then that's going to be a significant drain on consumption in the economy, and all other sectors in the economy, even if they're not energy intensive, are going to feel that hit unless there's action to smooth that impact.
Dan, let me fold two questions into one because we're running out of time. Do you expect to see more closures, bankruptcies across industry as a result of this? And secondly, a lot of variables, I know, but what is your view, your sense of when prices return to stability or indeed return to kind of pre-war levels?
Yeah, it's a big question. I mean, I think with an economic shock like this across the economy, you'd be surprised if someone didn't fold. I'm not sure we're going to see the same number of suppliers falling as we saw last time, because that was particularly related to their lack of hedging ahead of the first round of rises. I think we're going to see these elevated prices for some time yet. Ultimately, what Europe has woken up to is the need to get off Russian gas dependence. They may still buy Russian gas, but they're not going to be dependent on it. But that'll take time. You need to build the import terminals to buy American and other liquefied natural gas from around the world. And that may take until the mid-2020s. It could be as late as 2027 before prices fully stabilize at a new long-term normal. We're not immune to those prices in the UK because it's an integrated market. Notwithstanding, we do have access to those LNG sources already in this country.
Okay, we need that infrastructure onshore, don't we, to store that gas. Dan Monzani, Managing Director at Aurora Energy Research and former Director for Energy Security at the UK Government's Business Department. Some really fascinating insights there in terms of price stability, maybe not until 2027, and that need for additional direct intervention by the government to help households and possibly businesses as well. Thank you. Coming up, the hawkish chorus of Fed officials set the stage for Jay Powell's hotly anticipated speech later. We will bring that speech, of course, live on Bloomberg TV later today. Do not miss it. 3 p.m. London time. This is Bloomberg.
As the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage continues on Bloomberg Television and Radio.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The Fed chair's speech is the main event on Friday. Thursday, the talk of the conference was liquidity, but not the Wall Street kind. A massive storm hit Grand Teton National Park, flooding the roads and blowing down the TV tents, and creating its own inverted yield curve. Jay Powell's speech may not have an impact on the markets quite as dramatic, as investors have already priced in a hawkish message. Even if he says nothing new, they will probably take it that way. Meanwhile, we've had requests for a sequel to our history lesson on how the Federal Reserve ended up here. How did Grand Teton become a national park? A higher power took care of the mountains, scientists think about 2.2 billion years ago, Fast forward to 1929, and a small portion of this area became a national park. And then came John D. Rockefeller. He was so enchanted with the area, he basically bought almost all the land between here and the town of Jackson. And in 1943, he donated 43,000 acres to add to the national park. Now, this is where the deer and the antelope play. Grand Teton and Yellowstone to the north are also home to bison and elk. And once a year, in late August, you can spot central bankers in the wild here in Grand Teton. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Okay, Bloomberg's Michael McKee with the next installment of the history lesson from Wyoming, and of course that impressive headgear getting announcing once again. Jackson Hole, of course, that symposium getting underway, and we will have that speech at 3 p.m. of course across Bloomberg TV. We also spoke to the host of the symposium, Kansas City Fed President Esther George. She says the Fed may have to take interest rates above 4% for a time, as current rates are not weighing on the economy.
The chairman will deliver the opening remarks. I haven't previewed his remarks, so I can't tell you what's in there, but I will just tell you from my own perspective, Kathleen, it's very important that we are clear in our communication about the destination we're headed. And I think that destination is important, which is we have to get interest rates higher to slow down demand and bring inflation back to our target over some period of time here.
So let me ask you, Esther George, in particular then, are you willing to keep hiking rates if you see unemployment rising, if you see the economy slipping towards what could be a recession, even into recession? Are you willing to stay on that path if inflation is still too high?
So I think we have to, by mandate, bring that inflation rate down. And right now, the unemployment rate is running below, I think, what most people believe is a natural rate of unemployment. So the labor market is too tight. And by bringing demand down, we should begin to see the labor market loosen up a bit. I think we're already seeing some early signs of some of that consumption, some of that demand leveling off. But certainly you are not seeing it fully in the inflation data yet. It is still very broad-based, and I think tells us there's more work to do.
Well, the general consensus among you and your colleagues seems to be you raise rates to a restrictive level and you leave them there for a while, rather than start to bring them back down again. So what's your level, and how long do you think that they would have to stay there?
So I think knowing the exact level, knowing the exact number is really going to be a process. I couldn't tell you today where we are today is not restrictive, I would argue, yet. We still have high inflation. So I think it tells us we have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts, seems a bit remarkable to me. I think we will have to hold.
Over 4%?
It could be it could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
You've been doing this for a long time. The old adage was, don't fight the Fed. Why do you think the markets are fighting the Fed now and not listening to what you've been saying about how serious you are about taking on inflation?
I don't know what drives the markets, Mike. I probably would not be well positioned to say that. Certainly, it is important for our communications to be clear because we want financial conditions to tighten along with the direction we are moving around policy. So I think it puts a premium on being clear in our communication, of having resolve toward the end game here. And again, the end game is to bring inflation back to our 2% target. And that's challenging in the environment we're in. We're coming off an unprecedented period. The economy, I think, in some respects, is still sorting itself out. We have global factors to take into that. So there's a lot to think about. I'm sure markets are thinking about that even as we proceed with this interest rate increase cycle.
Kansas Fed President Esther George there with that beautiful backdrop, of course, of Wyoming, Jackson Hole. Joining us now is Marcus Ashworth, Bloomberg opinion columnist. Marcus, are the markets setting themselves up for a bruising?
I think they are probably, because it just depends whether or not we get this nothing burger of, I suppose, Powell just trying to sort of keep along with the message which he's basically failed to deliver, as some excellent comments and questions there from Tom and Kathleen, because you can see the Fed are struggling to convince perhaps even themselves that what they're doing is working. I just worry that they overdo it and we get too much hawkishness. I would say the markets are quite well set up for a hawkish speech, but as ever, they will look for the slightest bit of dovishness and priced off that. So the risk may be therefore that Powell overdoes it and scares stocks and indeed bond yields. But look, maybe it'll be just a nothing burger, as my colleague Jonathan Levin wrote.
It could be the nothing burger. It strikes me that Jay Powell has spoken consistently about the strength of the jobs market. There's little evidence that that is weakening significantly in the US, and that he'll use that as ballast, arguably, to go harder when it comes to this rate hiking. So that for you is a risk? Is it the strength of the labour market and forcing the Fed into a more hawkish stance that maybe is necessary?
Yeah, I mean, it's rare I agree with Jonathan Stiglitz, but he has a very searching point. A lot of this stuff is supply side. What is hiking interest rates going to do to help inflation, other than push inflation up in some ways? Now, this is the problem which even Powell's highlighted, is that they don't really understand inflation. He says they know a lot more about why they didn't know anything about inflation. Well, that's great, but I mean, I do think they need to understand the dynamics between forcing or killing demand to such a level that it pushes up jobs. How do you stop that? There seems to be some great confidence they can land the economy on some soft point. And I've always gone on about why is a 2% inflation target practical in a scenario like this? We're so far above.
Yeah.
There needs to be a more practical solution to not crash the economy, to get supply side inflation pressures down, because it's not going to work or end well, unfortunately.
Marcus, we just threw up a terminal chart showing the kind of hike and hold thesis that's kind of coming through from some of the Fed officials, and we heard there from Mr. George, maybe you get above 4%, you have to hold on those or in those levels or around that range. Are markets priced for a kind of hike and hold?
No, and they know that the reason they're not priced for that is because they know it won't happen. It's. Do you remember flexible average inflation targeting? That did not last long. And I suspect the hike and hold policy really won't work because, the natural rate for interest rates are probably lower than the Fed is hoping to keep them at, should we say, at 4%. I want to even get close to it. But the point here is that they actually think they can leave it for years or certainly protracted quarters. I think the economy moves too fast and events move too fast for them just to be on neutral and a hold. I don't think it works like that. I appreciate the message they're trying to send, and that's what's all about here. It's the messaging. It's just the market doesn't really want to hear it.
Okay, Marcus Ashworth on the bruising for these markets potentially, or the nothing burger from Jay Powell. Thank you very much indeed. Of course, Bloomberg opinion columnist. Plenty more coming up. Stay with us. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open, 53 minutes into the European trading day. Just pairing some of the earlier gains we've seen across the European space, gains of a little under 0.2%. Futures in the US, S&P E-minis pointing lower by 0.2%. Let's get to what's happening in the semiconductor space now. The machines needed to make the world's most advanced chips are miracles of modern engineering, but they are also incredibly energy intensive, so much so that Taiwan Semiconductor Manufacturing, TSMC, of course, the world's largest supplier of outsourced semiconductors, is soon expected to consume more energy than the entire population of Sri Lanka. One company, more energy than an entire nation. Joining us now is Bloomberg's Betty Ho in Taipei. Betty, what is the problem then? What are the linkages between advanced chip making, these EUV machines, and that demand for electricity?
Yeah, exactly. So these EUV machines, called the extreme ultraviolet systems, are essential in advanced chip making. You need them to make any types of semiconductors that are more advanced than the 7-nanometer semiconductors, which is why these machines are in so much demand right now. But really, the problem is these machines are also extremely energy consuming, that it generally consumes 10 times more energy than the previous generation of the chip making equipment. So we're really seeing kind of a dilemma right here, because we are seeing unprecedented demand in more and more complicated and smarter semiconductors, while the energy consumption is also a very crucial problem. And that is the dilemma that a lot of countries are facing right now, like Taiwan and South Korea, where they house really big chip makers in their land.
Yeah, I mean, absolutely. So they've got this massive demand, the massive energy use. Surely, though, this isn't sustainable longer term. What is being done? What is being worked on to kind of address this issue? Is it alternative sources of energy, or is the technology being refined to become less energy intensive?
You're right. So the crucial thing for these countries that house these major chip makers lies in renewable resources for energy. But really, the problem that we're seeing right now is, for example, Taiwan only generated 6% of their power from renewable resources last year. That is way behind the government's own initial goal. And the same thing we see in South Korea. Also, around 6% last year came from renewable energy. So these two countries both still rely on fossil fuels a lot. So we do see the concern rising here in whether these countries can generate enough power for the chip makers and for the people living there, as well as staying on the progress of becoming more environmental friendly.
Okay, fascinating story in Bloomberg Business Week, worth reading, written by Betty Ho and others. Joining us out of Taipei, thank you for the latest on terms of the energy demand around chip making. We're coming up to the close, of course, for the European market open. Surveillance early edition is next. Up next, your markets here in Europe, gains of 0.1%, pairing some of the earlier strength. Future stateside dipping down by 0.3%. It is all about Jay Powell. Stay with us. This is Bloomberg.
you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts. Seems a bit remarkable to me.
The Fed needs to be now much more front-loading than before, so as to ensure that you are coming ahead of the curve. And I would not worry about overshooting with interest rates for a while to build up credibility.
I think that Fed has to be able to risk a recession.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Here's what's coming up on today's show. Jackson Hole in focus. Jay Powell will be under pressure to hit all the right notes in today's keynote speech as a hawkish chorus of Fed officials set the stage. Tech relief, progress in the dispute over Chinese listings in the US boosts stocks. Plus, no let-up, the cost of the UK's winter triples as Ofgem raises its energy price cap to a record. Let's check in on these markets. Some of the early market optimism starting to wane now. A bit more of a holding position ahead of that important speech, of course, that crucial speech for many by Jay Powell later today out of Jackson Hole and Wyoming. Here in the UK, of course, still digesting that news. Not a big surprise, but still monumental in terms of the energy price increases. The cap being raised around £3,500 per household, a tripling there. Across your broader markets, futures stateside now pointing lower by 0.3%. And again, the gains that we've seen in Europe pairing somewhat. The expectations from many in these markets, they're going to get a more hawkish set of commentary from Jay Powell. They're going to push back on this idea from some of the markets that you're going to get a pivot in early 2023. In terms of euro dollar, just below parity still, not a lot of movement in the single currency. The 3-year or the 10-year, 3.07. You have seen yields ticking up, more pronounced towards the long end. So a move there of 5 basis points on the benchmark US 10-year, currently at 3.07. Brent currently $100 a barrel, gains of 1.4% for oil. You've seen upside in terms of basic resources and the energy space this morning. Continue to, of course, focus in on what's happening when it comes to natural gas prices as well. An emergency meeting from ministers in Europe to address what is happening in terms of those skyrocketing gas prices. The CAC going over in France, gains of 0.3%. You're seeing gains of about 0.5 here in the UK. The DAX in similar territory to the CAC, gains of 0.3% there. And Italy also at around that level as well. We're looking ahead to political risk as well, 1 month on ahead of those elections out of Italy, with a far-right coalition looking most likely as things stand. Let's get back then to the Fed. It is, of course, all things Jay Powell today. The annual Jackson Hole Symposium gets underway in Wyoming, and markets are bracing for a much-anticipated speech by the Fed chair. For a bit of colour and context surrounding the symposium, Bloomberg's Michael McKee has more.
The Fed chair's speech is the main event on Friday. Thursday, the talk of the conference was liquidity, but not the Wall Street kind. A massive storm hit Grand Teton National Park, flooding the roads and blowing down the TV tents, and creating its own inverted yield curve. Jay Powell's speech may not have an impact on the markets quite as dramatic, as investors have already priced in a hawkish message. Even if he says nothing new, they will probably take it that way. Meanwhile, we've had requests for a sequel to our history lesson on how the Federal Reserve ended up here. How did Grand Teton become a national park? A higher power took care of the mountains, scientists think about 2.2 billion years ago. Fast forward to 1929, and a small portion of this area became a national park. And then came John D. Rockefeller. He was so enchanted with the area, he basically bought almost all the land between here and the town of Jackson. And in 1943, he donated 43,000 acres to add to the national park. Now, this is where the deer and the antelope play. Grand Teton and Yellowstone to the north are also home to bison and elk. And once a year, in late August, you can spot central bankers in the wild here in Grand Teton. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Okay, the one and only, of course, Michael McKee of Bloomberg, giving us another history lesson from Wyoming, of course, throwing ahead to that important speech. We are joined now by April LaRousse, fixed income investment specialist at Insight Investment. April, thank you for joining us in the studio. What do you make of the market reaction and the market moves leading up to this speech by Jay Powell? What does it tell us about sentiment?
Well, everyone's hoping that they're actually going to say something meaningful about the pace and magnitude of interest rate rises, but frankly, we're not expecting you're going to see much. If you look back at 45 years of Jackson Hole, mostly it's been analysis. It hasn't been kind of big predictions or announcements. Clearly, last time Jackson Hole happened, it was all about transient inflation. This time, we think it's going to be about explaining why inflation is so hard to predict, where it's coming from, and thinking about ways to solve things like supply chain issues, labor market problems, etc.
So more of an academic deep dive in terms of inflation forecasting rather than a clear guide from Jay Powell in terms of where rates go from here. The market's still split on whether you get 50 or 75 in September. Some Fed officials, though, suggesting that we get to a point where we hike and hold. What is the market reaction to that scenario? Of course, it depends where we hike to.
Yeah.
Dot plots at 375 by the end of the year. If you hold at those kind of levels, what is the market reaction and fallout from that?
Well, the market's expecting interest rates to start going down by the second half of next year.
Are they wrong?
We think so, yes. I mean, there doesn't really seem to be a reason that inflation would be tackled so quickly, given inflation is so widespread. It's not just food and energy. Core is going up as well. Wages are going up as well. So it's going to take a little bit longer to tackle inflation. There would be no real reason to do an about-face so quickly. And in fact, there's lots of reasons to suggest that that could just allow inflation to rekindle, assuming that it had started to tail off before that point. So we think rates go up, maybe they go up a little higher than 375, and then they stay where they are for quite some time until the inflation dragon has been well and truly slayed.
There's all sorts of variables that go into this, but when you say quite some time, does that take us through 2023 in terms of having those elevated rates at a more persistent level?
Yes, I absolutely. I mean, and obviously things can happen,
yeah.
And should there be a massive change in something like economic growth, for example, or energy prices, probably more importantly, then of course things can change. And all the central banks are saying the same thing. They don't really want to do too much guidance. They'd rather be quite flexible because things keep changing. So they don't want to have to kind of backtrack. And it's important to just say, let's wait and see.
Is quantitative tightening, which is going to be stepped up, is that being underestimated by the markets?
Well, it's not being focused on at the moment for sure. And they have indicated that they'd like to shrink the balance sheets. So the question is, do they actually continue with that plan? Do they sort of, reduce the magnitude of the unwind? That we will have to wait and see. But we don't think you're going to get much conversation on that at the Jackson Hole symposium.
We still have the yield inversion, 2s, 10s, around 230 or something on the 2s, around 2.07, 3.07, I should say, on the 10-year. A bit of a movement in terms of yields, particularly at the long end today. Where do you want to be positioning across that yield curve, if at all?
Yeah, well, that is the million-dollar question, actually. I think really when we're looking at what the market is telling us about the yield curve, is it is telling us a recession is coming. You know, anyone can see that. Even central banks are kind of reluctantly admitting that a growth contraction is probably what's coming. In that sort of environment, maybe it isn't a big move in the yield curve overall, but actually perhaps you see all yields just shift a little bit higher as they come to realize that interest rates really do need to go up and stay up for longer than is priced in.
Okay, April, we'll get more of your analysis and more of your thoughts after the break. Thank you for coming to the studio. Of course, April LaRousse, fixed income investment specialist at Insights Investment, staying with us. Get more of our calls in the next couple of minutes. Coming up, a hawkish chorus of Fed officials, as we mentioned, set the stage for Jay Powell's hotly anticipated speech. We will bring you that speech live on Bloomberg TV later today. Do not miss it. 3 p.m. London time. This is Bloomberg.
Digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Pressure is mounting on European leaders as energy prices continue to soar to levels last seen during the early weeks of Russia's invasion of Ukraine. Here in the UK, the average household will pay almost triple the price to heat their home this winter compared with a year ago. That's after the industry regulator Ofgem raised the energy price cap on the back of soaring gas prices. April LaRousse, fixed income investment specialist at Insight Investment, is still with us. April, how do you factor in this energy price crisis and shock when you're looking at the fixed income space? To what extent is this priced in or not by markets?
Well, we all knew it was coming.
Yeah.
The problem we see is that at the moment we don't have a proper government, right? We're waiting for the new prime minister. The help that was offered to consumers, which was around £15 billion, is not sufficient. You probably need a whole nother package to come through. And if it is a trust government, it will take some time to get that organized. Clearly, the UK economy is in a big mess, so the new prime minister will have a very difficult job. In terms of how the gilt market is behaving, however, it's been interesting to see how very recently it's really markedly underperformed other markets. I think what's happened is financial markets seem to have woken up to the idea that the UK has the highest level of inflation of all the developed markets. It's got issues with insufficient labor. And I know a lot of countries are suffering from that, but the UK has an additional complexity of Brexit. So it is, and we still haven't ironed out our relationship with the EU.
Is this a basket case economy?
Well, let's not be too harsh, but it is, there are some things that need sorting, and we need a strong government to do it.
But to your point on yields have jumped, as you say, the sell-off in gilts, and yet the pound has not been supported. In fact, the pound's been going in the opposite direction. Does that point to a potential currency crisis?
I think the jury's out on that.
Okay.
We're not really expecting to see the pound struggle more than, say, the euro, for example.
Okay. Talk to us about the credit space and whether or not you see yields have come in a bit in terms of credit. Does that trend continue? And how much risk do you want to be taking within credit? Do you want to be staying in investment grade, or is it time to push out?
Yeah. Well, given the huge widening we've seen in spreads, it's hard not to look at that and think, there's some interesting value here. I think the issue is the markets are, of course, going to be looking into a winter where perhaps energy disruption and certainly more expensive energy is going to be an issue. We're going to have slowing economic growth. So, yeah, definitely credit is interesting now, but being quite cautious about where you're investing. Less cyclical sectors, for example, investment grade perhaps favoring over high yield. You still want to be a bit cautious, but there's absolutely value that's been created in the sell-off. So we are looking for opportunities.
Okay, so still value within investment grade, particularly. When it comes back to the sovereign space, and before we let you go, the politics of Italy back in focus, the countdown to that election. Do Italian spreads, do Italian yields, I should say, do they remain relatively well behaved, or is there a blowout potential? Have the ECB laid out a framework that's going to keep investors assured that there isn't going to be fragmentation?
Well, we've got a lot of tools in the toolbox. We now have the TPI, and it will be utilized as long as whatever new government is formed in the next month actually looks like they want to behave in a fiscally responsible way and follow the European rules. And if that is what's being communicated by the new government, then of course the TPI will be utilized, and the other ways of keeping spreads at a sensible level. Italy has the potential to see further widening from here, but there are certainly ways to contain that as long as the comments from the new government are towing the European line.
Yeah, Meloni, who is the likely, possibly as the polls suggest, the likely Prime Minister, saying they will be a fiscally responsible government, but of course we'll have to watch to see what actually happens if indeed she does take power with that coalition and what the implementation looks like. Thank you very much indeed. April LaRousse, the views there on the sovereign and the broader, the corporate credit space as well. April LaRousse, fixed income investment specialist at Insight Investment. Thank you. Let's get to the Bloomberg First Word News now with Leanne Goerens. Leanne.
Good morning, Tom. President Vladimir Putin has ordered the Russian military to increase its armed forces by 137,000, or more than 10%. The decree did not explain whether that would happen with a draft or by upping the number of volunteer soldiers, or actually both. So far, the Kremlin has avoided a mass mobilization as it seeks to limit the domestic fallout from the war with Ukraine. White House Chief Medical Advisor Anthony Fauci says he expected the U.S. would have moved past COVID after the first year of the Biden administration, but the disruption from the virus has lingered longer than he actually anticipated. The infectious disease expert has been speaking days after announcing he's stepping down at the age of 81.
I thought after yet again another year, we would have COVID behind us. But as it turns out, that's not the case. We've just got to get more people vaccinated and more people boosted. That I think we're really on the threshold of getting COVID to the point where it is at a level where it is low enough that we can actually not have it disrupt the social order.
Meanwhile, global monkeypox cases have declined for the first time in a month, led by a drop in infections across Europe. The WHO says new cases fell 21% overall in the last week, but continue to rise in the Americas. 6 countries have not reported new infections for more than 3 weeks now, the maximum incubation period for the disease. And Novak Djokovic has confirmed he'll not play in the US Open, the year's 4th and final Grand Slam event. The tennis Star's participation has been hit by the America's vaccination requirement for international travelers. One of the few remaining COVID-era rules in the country, Djokovic's anti-vaccine stance did become a real flashpoint after he was removed from Australia back in January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you. Coming up, UK household energy bills are set to soar as the regulator announces a massive rise in the price cap. We've got more on that story next. This is Bloomberg.
Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage continues on Bloomberg Television and Radio.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Welcome back, Economics, Finance, Politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, the average UK household will pay almost triple the price to heat their home this winter compared with a year ago. That is after the industry regulator, Ofgem, raised the energy price cap on the back of soaring gas prices. Let's bring in Bloomberg's Todd Gillespie then to walk us through this announcement and the implications. Not a big surprise, it's still huge, but we knew, looking at the methodology, that the levels were going to be raised around this amount. What does it tell us about price pressures across households and where prices go from here, Todd?
Yeah, absolutely. I mean, the methodology for this is quite transparent, but that also makes it scarier in a way because you can see down the tracks that this is going to get even worse. I mean, we've had the first estimate today that came out for April price cap from one consultancy predicts that it's going to rise above £7,000. So that's double winter in April.
So that's April, £7,000. We're at 3,549 and change now, up to 7,000 by April.
Potentially, yes, and about 5,500 in January based on current market prices. The issue is that it's hard to predict what level this is going to be because there's an observation window that is based on market prices that are very volatile, and that window only opens the closer you get to the price cap.
So what are the options for the government at this point?
I mean, there are lots of options. There are fairly few that have been actually put on the table so far because we are, having essentially a postponing of big policy before the new Prime Minister is announced on September the 5th. So, I mean, there's a wide range of things from nationalising energy suppliers to freezing bills entirely like they've done in the Isle of Man, which is slightly separate to Westminster policy making. It would cost at least £29 billion, at least to do it in the short term. If you're looking further ahead, suppliers, some of them have been calling for a £100 billion package to help smooth and stabilise prices over the next 2 years, on top of further benefits, household support for the lowest incomes. One supplier this morning has basically been saying we should quadruple the support for the poorest households, which is known as the warm home discount. But there are all these different policy options. Most of them do involve handouts. Most of them do involve a lot of money. But also, these things could help smooth out inflation as well when we, look ahead to sort of delaying the shocks that will come to the economy. Depends, how you want to divvy that up and where you want that to come.
We cannot get to £7,000 per household. For so many households across the country, that would be more than their mortgage payments. Absolutely. It would be totally unsustainable. What about businesses? Before we let you go, Todd, in terms of the business impact, businesses not protected by this price cap.
Absolutely, yeah. I spoke to one business earlier this week who's had a 9-fold increase in their bill. Other ones that have shut down entirely. So we're seeing, small takeaways, pubs, all the way up to big manufacturers, all really feel the pressure from this. And Bloomberg's reported also this week that the government's well aware of the risks of this. Well more than a year ago, and the planning for this is essentially now coming down to thinking about what we can shut down without damaging the economy too much. So it really is a case of damage limitation at this point because there is no cap right now for businesses at all. They are fully exposed to this volatility of the wholesale
market. Great stuff. Thank you, Todd. Todd Gillespie walking us through what's happening in the energy space, particularly here in the UK for households and businesses. There are possible tools at the disposal of the government. It's the ones that they reach for, but there will be a cost as well. Coming up, a hawkish chorus of Fed officials set the stage for Jay Powell's hotly anticipated speech. Later, we bring you that speech live on Bloomberg TV. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Jackson Hole in focus. Jay Powell will be under pressure to hit all the right notes in today's keynote speech as a hawkish chorus of Fed officials set the stage. Tech relief, progress in the dispute over Chinese listings in the US boost stocks in Asia. European stocks and US futures fluctuate ahead of Jackson Hole. Plus, no let-up. The cost of the UK's winter triples as Ofgem raises its energy price cap to a record. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Looking ahead, of course, that focus on the speech from Jay Powell later today. Bloomberg TV also spoke to the host of the symposium, of course, in Wyoming, Kansas City, Fed President Esther George. She says the Fed may have to take interest rates above 4% for a time. They're currently around 2.3%, as current rates are not weighing on the economy.
The chairman will deliver the opening remarks. I haven't previewed his remarks, so I can't tell you what's in there, but I will just tell you from my own perspective, Kathleen, it's very important that we are clear in our communication about the destination we're headed. And I think that destination is important, which is we have to get interest rates higher to slow down demand and bring inflation back to our target over some period of time here.
So let me ask you, Esther George, in particular then, are you willing to keep hiking rates if you see unemployment rising, if you see the economy slipping towards what could be a recession, even into recession? Are you willing to stay on that path if inflation is still too high?
So I think we have to, by mandate, bring that inflation rate down. And right now, the unemployment rate is running below, I think, what most people believe is a natural rate of unemployment. So the labor market is too tight. And by bringing demand down, we should begin to see the labor market loosen up a bit. I think we're already seeing some early signs of some of that consumption, some of that demand leveling off. But certainly you are not seeing it fully in the inflation data yet. It is still very broad-based, and I think tells us there's more work to do.
Well, the general consensus among you and your colleagues seems to be you raise rates to a restrictive level and you leave them there for a while, rather than start to bring them back down again. So what's your level, and how long do you think that they would have to stay there?
So I think knowing the exact level, knowing the exact number is really going to be a process. I couldn't tell you today where we are today is not restrictive, I would argue, yet. We still have high inflation. So I think it tells us we have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts, seems a bit remarkable to me. I think we will have to hold.
Over 4%?
It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
You've been doing this for a long time. The old adage was, don't fight the Fed. Why do you think the markets are fighting the Fed now and not listening to what you've been saying about how serious you are about taking on inflation?
I don't know what drives the markets, Mike. I probably would not be well positioned to say that. Certainly, it is important for our communications to be clear because we want financial conditions to tighten along with the direction we are moving around policy. So I think it puts a premium on being clear in our communication, of having resolve toward the end game here. And again, the end game is to bring inflation back to our 2% target. And that's challenging in the environment we're in. We're coming off an unprecedented period. The economy, I think, in some respects, is still sorting itself out. We have global factors to take into that. So there's a lot to think about. I'm sure markets are thinking about that even as we proceed with this interest rate increase cycle.
Kansas Fed President Esther George there. We're joined now by Thomas Coster, Senior U.S. Economist at Pictet Wealth Management. Thomas, thank you for joining us. What are you expecting then from the speech from Jay Powell? Is it going to be a nothing burger or a slapdown for the markets?
Right. So actually 2 points. One is that the Fed started to pay more attention to growth data at the July meeting. So they were taking more into account the growth picture and not just inflation. I would expect that to actually continue. I think we should not expect a pivot. It's still too early, but I think the Fed at the margin will pay more attention to growth data. Point number two is the reaction function of the Fed should also change. I think they'll take more into account the leading indicators and not just the backward-looking data. And they will, I think, pay more attention to the recession risks. So in the end, I would expect Jerome Powell to indicate that they could modulate and probably diminish the pace of rate hikes in the coming weeks and potentially as soon as the September meeting. But again, I think for a true pivot to happen, I think we're still, it will be down the line and we're not yet, I think they're not yet ready for a full pivot.
Okay, very interesting, Thomas. That sounds like something that would be interpreted as a dovish signal by the markets.
Well, I think the market has built, some very hawkish expectations going into this Jackson Hole meeting. It is true that most regional Fed presidents that we've heard in August were on the hawkish side. They've insisted on the fact that inflation is still high. But again, I think inflation has probably peaked in the U.S., which is not the case in Europe, but at least in the U.S., it's the case, I think. And point number two is that the data is going to deteriorate, so there's less demand in the economy, and that should also bring down inflation down the line. So, the recession risks are quite high, and I do think that, Jerome Powell is also listening to that, in contrast to some other, regional Fed presidents who are more focused on the backward-looking inflation data.
We have Esther George. We heard from her just a couple of seconds ago saying that maybe you might have to get to 4% and hold it around that level. What for you is the terminal rate then, given what you've been saying about that additional focus on the economics and the slowdown in the economy? And where do you think that leaves the dollar?
Right. So I do think it will depend on the job market in the end. The job market has been quite resilient, and as long as that's the case, the Fed could continue to hike interest rates. Though I would expect, the labor market to come under some pressure. Most other economic indicators have been softening lately. Obviously the pain right now is in the housing market, but I think it will eventually come and catch up with the labor market. So I would expect the labor market to start really to soften by the end of the year. And I would expect the Fed to stop potentially the rate hikes by then. So I would be probably on the lower side versus current market expectations.
That's interesting. So the labour market's starting to catch up with what's happening in housing, maybe a softening of the labour market by the end of this year. Thomas, talking of the housing market, mortgage rates on the 30-year back up above and around 5.5%. And we've seen on a number of fronts a slowdown across the housing market in the US, as you mentioned. Is it still the canary in the coal mine for the US economy?
Well, I would tend to think so. Housing is only 5% of GDP when you look at the residential investment share of GDP, but there are some spillover effects into the rest of the economy. And so I'm a bit surprised that the Fed is not paying more attention to the housing market. I mean, the data is actually quite weak. New home sales were down almost 30% year on year in July. I mean, that's quite a big drop. And I think soon you will see, home prices starting to soften as well and potentially go into, go negative year on year, based on the correlation with rising housing inventories. So, yeah, I think the housing sector is still the canary in the coal mine. I think that will be the main reason why the U.S. goes into recession. However, it should be a mild recession because there are no, we don't have the same imbalances in the economy that we got during the subprime crisis. I think that's the silver lining here. But still, I think the downturn in the housing market could be strong enough to push the U.S. into a mild recession.
Okay, and talk to us about the linkages between the housing market and the health of the all-important U.S. Consumer. At the front end of this year, a lot of our guests were saying, look, the balance sheets of households in the U.S. are very solid. How much fragility is there now amongst the U.S. consumer, particularly as these house prices come off?
Right, and yeah, you have two views in the market about the health of the U.S. consumer. One is that balance sheets are strong, but there are still some details showing that there's a massive increase in leverage, and especially about consumer credit is coming back and quite very fast. And that may suggest that actually for some consumers that they've already run out of savings, and we may be close to the end of the runway in terms of their purchasing power, especially as inflation is high. So I'm a bit more worried about the U.S. consumer than most. And I would like to see a bit more spending coming from incomes rather than from credit. But I do not think that the consumer is really the problem. I do think that what I watch the most right now is the housing market, inventories as well, and business capex.
Okay, the importance of the housing market. Thomas, before we let you go, 50 or 75 in September then?
So we're in the 50 camp, but that will depend on payrolls as well as on the ISM index as well. I think the ISM could gain more importance in the Fed's reaction function. I would expect the ISM to be in contraction, but we shall see.
Okay, excellent insights. Thank you. Thomas Costa, Senior U.S. Economist at
Thank you very much.
Wealth Management, joining us from Geneva. Have a great weekend. Coming up, Italians go to the polls in a month. We will discuss who may replace Mario Draghi next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
it's a long list, but the Fed has to focus on inflation and has to do it in a more committed fashion than it's done it so far.
So it's been trying to sound, Mohammed, committed, right? I mean, they've basically been saying inflation is their number one issue that they're facing. Why is the market not hearing it?
Two reasons, Lisa. One is the Fed itself. Let's not forget that Chair Powell stated that we were at the neutral rate. The minute the market heard that, it moved, and it moved in a significant fashion, and all the talk about pivot started being amplified. So that's one reason that the communication hasn't been consistent, and that's been a problem for the last year. And the second issue is that the market is looking at the impact on growth, is looking at the potential impact on markets, and as John said earlier today, remembers the fourth quarter of 2018, remembers the Fed blinking, so it believes when push comes to shove, the Fed is going to blink again, that we're going to have a flip-flopping Fed.
Mohammed, what I hear from you is that you don't think this Fed blinks anytime soon.
I don't know, John. I know what they should do, which is they should not blink. But it's been very difficult to call this Fed. This Fed has unfortunately failed at analysis, failed at forecast, failed at communication. So it's very difficult to say what this Fed is going to do. It's easier to say what it should do, but it's much harder to say what it's going to do. And that's why you get this disconnect that you've been talking about between the markets and the Fed.
So let's go there and wrap up this segment with you on what you think. Larry Summers called that neutral comment analytically indefensible. You said on neutral, and I think you were a little bit more diplomatic about it when we last spoke, you said the zip code for neutral was higher than where we are right now. Mohammed, what is the zip code for neutral, and how on earth do we know with inflation where it is and where rates where they are right now?
So I don't know specifically where it is, and I've been warning against spurious precision. There are so many structural changes going on. We are changing liquidity regimes. I said earlier, we're going from a world of deficient aggregate demand to a world of deficient aggregate supply. That's the world we live in now. No one knows for sure where neutral is. So you've got to try to figure out as you go along the way. And you mustn't attempt this spurious precision, because if you do, the market is going to jump immediately to conclusions, and then you're going to have to undo it. You know, the Fed itself, Fed officials have walked back that comment. It didn't take many days.
Okay, Bloomberg opinion columnist Mohammed El-Erin there saying the Fed should not blink when addressing inflation. Let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Hi, Tom. The UK regulator has lifted the cap on energy, gas and electricity bills to £3,459 a year from October. Liz Truss, a frontrunner to become Prime Minister, is reported to be planning more help on energy costs within days of taking office. European Energy, meanwhile, has extended its rally, adding pressure on the region's politicians to do more. In France, the cost of power hit a new record after EDF said more of its nuclear reactors will take longer to come back online after stoppages. Now, OpenText Corporation of Canada has struck a deal to buy UK software firm Micro Focus International for about $6 billion, including debt. The offer comes at a 99% premium to yesterday's closing price and builds on the Canadian firm's strategy of growth by acquisition. Micro Focus sells enterprise software to businesses including Airbus, Hewlett-Packard and Kellogg. Twitter has been ordered to hand over more information about spam and bot accounts to Elon Musk. The judge has ruled it must turn over information about 9,000 accounts it surveyed last year. Twitter had sought to deny Musk access to this historical snapshot on privacy and other grounds. LastPass, a password manager used by more than 33 million people around the world, says a hacker recently stole source code and other information, but the company says it doesn't believe any passwords were taken as part of the breach. And that's your Bloomberg Business Flash. Tom.
Leanne, thank you very much indeed. Okay, it is just under 1 month until Italy holds a snap election. It comes after a unity government led by Prime Minister Mario Draghi collapsed last month. To get a preview then on the upcoming vote, let's bring in Bloomberg's Alessandro Speciale in Rome. Alessandro, what is the polling data then telling us about this election and who the frontrunners are?
It's a very clear, it seems right now that the outcome was very clear. The only question is whether the right-wing coalition led by Giorgia Meloni will score a big victory or whether the coalition will score a huge victory. Some polls even put her within reaching distance of having a 2/3 majority in parliament, which would allow the right-wing coalition to change the constitution on its own without needing external votes. This is a very clear situation, and this is also one of the reasons that Draghi's government failed. The opportunity was too good to go to early election and capitalize on this very good moment with the electorate for the right wing.
So big or huge, it sounds like Meloni is almost crossing the line on this victory. We'll see. We're a month away. What are the main themes dominating the campaign then, Alessandro?
Well, of course, energy is one of the key themes. The left-wing, center-left coalition led by Enrico Letta is trying to revive its electoral fortunes by proposing price controls for energy for the next 12 months, something that Meloni is opposing. Then, of course, there is immigration, one of the strong themes of the right. And then there is what to do with the almost 200 billion euros that Italy is set to receive from the EU. This money is dependent on a program of reforms that Draghi was working really hard to implement, but now Meloni has said that she wants to renegotiate the plan, which could take months, and of course, if some milestones are not met, the disbursements to Italy could be stopped.
Yeah, indeed. And of course, they've come out and said, Meloni and her team have said that they will be fiscally responsible. But of course, any commentary on that and how they react is going to be important, isn't it, for the EU? Talk to us then about Giorgia Meloni, who she is, her complicated biography. There's the historical links, of course, uncomfortable, painful links to fascism in Italy. How close is she to that history?
Yes. Meloni, 45, has been a professional politician for more than 20 years. She's done all her life in politics. And as you were saying, she started in the youth movement of Italy post-fascist party. So her party, the party she leads now, Brothers of Italy, is a far-right party. Of course, they say they have cut ties with their fascist past, and this was many decades away, but of course this shadow remains. But there is another interesting factor that also contributes to explain Meloni's current popularity. She is, so to speak, the last woman standing. In the current term of parliament, her party is the only one that hasn't been in power, that hasn't been in government. We had 3 governments in the term of the current parliament, and Meloni's ability has been to stay away from being in a position of power for all her career. She was only a junior minister for 3 years at the beginning of her career. Ever since she's been a political operator, she's been in parliament, she's been in parties, but she hasn't taken any policy-making decisions. And this is the most interesting thing about her. She will have to take decisions if she becomes, and she wants, prime minister.
Very, very interesting realignment of the Italian political picture, just broken down brilliantly by Alessandro Speciale in Rome. Thank you for that update, a month away from that vote. Coming up, workplaces demands and the demands around workplaces, they are changing as younger generations enter the global workforce. We're going to look at how employee priorities are evolving, the implications for the economy. That is next. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change.
Reinventing climate news on TV, Quick Take, and Bloomberg.com.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Happy Friday. Now, how do Generation Z's or Z's workplace demands differ from those of today's staff? Bloomberg's Laura Wright has a deep dive into the future of work. Laura, how do younger workers then, how do their attitudes differ? How have they changed from their aging, greying colleagues like myself?
No, don't say that, Tom. Well, basically, the Centre for Economic and Business Research conducted a survey with UK employees on what aspects of their job they value the most. We can assume these trends can be extrapolated in other developed markets. And basically, a good work-life balance, job security, a respectful atmosphere, and salary are the top considerations. Now, notably, a good work-life balance has increased more than 30 percentage points from respondents over the last 10 years. And similarly, a respectful atmosphere has seen an increase of more than 20 percentage points. Salary, while it's fallen down the leaderboard, it's likely to move up given recent concerns surrounding cost of living. And they've also looked into what factors are likely to see the greatest increase in importance for Generation Z in the next 10 years. It's things like more flexibility, the option to work from home, and this aligns with recent research that office occupancy rates in the developed world have peaked at 40 to 50% after the pandemic. There's less appetite to be in the office 5 days a week. Now, environmental concerns are no longer a peripheral focus. Employees want to see concrete action, management opportunities, and business equity, essentially taking more ownership of your career earlier on.
Okay, Laura, right there on the changing demands around the future of the workspace from Generation Z or Z. Thank you. Checking on the markets before we let you go. Bloomberg Surveillance, of course, early edition continues next. Currently, European markets down 0.1%, a holding position really ahead of that all-important speech from Jay Powell. Kriti Gupta, Kaylee Lyons, and Anna Edwards here in London bringing you the latest next. Stay with us. This is Bloomberg.
These floating flowers are made of 92,000 solar panels.
Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an e-pool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
The Fed has been asleep at the wheel, and that's unfortunate.
I think the Fed solution, and I happen to agree with it, is slow the economy down.
I do think the Fed is going to push back on all this chatter about pivots.
I think Chair Powell needs to do a bit better in expressing more some candor about the past, not necessarily mea culpa, but for what happened, and about the future.
It's very important that we are clear in our communication about the destination we're headed.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Countdown to Powell. The Fed chair will be under pressure to hit all the right notes in today's Jackson Hole speech, as some of his colleagues stress the need to move onwards and upwards with rates. UK regulator Ofgem triples the price of winter for many households with a hike in the domestic price cap, whilst warning more hikes will come. And President Biden shifts into campaign mode. The US president touts a string of legislative wins and urges voters at a rally in Maryland to protect those policies. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines over in New York this Friday. Matt Miller is off today. And Kaylee, we've had some pretty hawkish warm-up acts to Jay Powell.
We have, Anna. What's interesting, though, is that it didn't really weigh on risk sentiment in the U.S. yesterday, and it didn't really in Asia overnight either. In fact, most stocks were higher. The MSCI Asia Pacific Index rallying by just a few tenths of 1%, about 0.4% or so. But some of the outperformance came specifically from big Chinese tech stocks and other Chinese tech stocks that also have listings here in the U.S. after a report yesterday that the U.S. and China are getting closer to an agreement on those auditing rules that potentially could prevent those stocks from having to delist from U.S. exchanges. So that led to a big boost in some of those shares, including GDS. Of course, the ADRs of GDS in the U.S. yesterday rose about 8%, and in the Asian session, they were up more than 5%. Of course, the other story in China we continue to follow is the stimulus to support the economy and specifically the property sector. And you're seeing some feed through to that in the commodities market, specifically iron ore, up about 3.5% in Singapore overnight. 106.75 a ton is where we trade. And finally, it is a stronger dollar story ahead of Chairman Powell's speech later today, Creedy, against pretty much everything in Asia, including the Japanese yen, weakening against the dollar to just shy of that 137 level.
And that stronger dollar story may certainly be playing a little bit of a role when it comes to the cross-asset picture. Take a look at the S&P 500 futures. They are down about 0.3%. No real selling conviction here, but still it makes sense that just seeing a little bit of a pullback in the equity market after, by the way, we got a 1.4% gain in the S&P 500 in yesterday's session. So once again, those technicals really coming into play here. The 10-year yield, by the way, higher, nonetheless, up about 4 basis points. Once again, perhaps reversing some of the massive moves we saw yesterday as well. You also mentioned the dollar index. Compared to other currencies, you are seeing some pretty big moves. When you look at the composite, the Bloomberg dollar index as a whole, well, it is kind of unchanged. So really look into the specific currency pairs for that kind of move and for the ripple effect there. And speaking of ripple effects, Bitcoin down to the tune about 1%. Is that some sort of crystal ball for what we're going to see in the stock market? I guess we're going to find out shortly, Anna.
Yeah, absolutely. The European map then, Chrissy, is a picture of, well, either an August trading day or the fact that we're waiting for something. And in this case, it's both. It is August and we're waiting for the Jackson Hole speech. As a result, we're pretty flat across the European equity markets. Quite a lot of grey on the map for you this Friday. Let's have a look at some of the commodities and some of the stock-specific stories that we're covering. I don't want to just talk about gas prices when they go higher. Also think it's important to mention when they come down. This is the natural gas price, still at incredibly elevated levels on that European benchmark, but it is coming down by 5.7%. It's been lower than this. It's been below 300 euros per megawatt hour a little bit earlier on in the session, but now down by around 6%. Relex PLC, this is a UK-listed publishing business, but its US business is in focus with analysts. They are saying that some of the changing rules around open source for federally funded research, that's going to limit the amount of money they're able to make on some of those research publications. And as a result, that stock and others in that sector are weaker. In fact, media is the weakest sector for European equity markets today. That could be something to watch over in the United States in the US session as well. Sanofi is up by 2.4%. The drug maker over in France, I could have put in here GSK or Haleon, both of those drug makers in the UK also rising on the same story. A tentative ruling from a judge in Florida has has investors asking themselves what kind of settlements might be needed to be paid to those who claim that their cancers are caused by antacids, which are made by those three businesses. And as a result, we're seeing some speculation that those payments will be reduced, and we are seeing those share prices move higher. Micro Focus, this is a software company based in the UK. FTSE 250 listed Kaylee, and we see it up by 92%. A Canadian company has made an offer for that business.
Yet a 92% move looks almost meme stocky, Anna, but I guess it does have something to do with the fundamentals. Speaking of the fundamentals, let's take a quick look at what is ahead today. We'll be getting some key U.S. economic data with personal income, PCE deflator, and the all-important University of Michigan consumer sentiment on deck this morning. But as we know, it is really all about Chairman Powell. He will be speaking at Jackson Hole at 10 a.m. New York time, 3 p.m. in London. We'll be bringing you live coverage of that speech, analysis, and market reaction. So buckle up, Creedy.
Absolutely. I think we all are. We have been all week long. Well, Bloomberg spoke to the host of the Jackson Hole Symposium, Kansas City Fed President Esther George, yesterday. She's among the Fed officials signaling interest rates will need to keep going up to fight inflation.
We have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts, seems a bit remarkable to me. I think we will have to hold.
Over 4%?
It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
Joining us now is Bloomberg Markets editor Christine Aquino. Christine, the markets are going into this Jackson Hole meeting with some very hawkish expectations. What could the reaction look like?
Well, Creedy, I think it really, again, depends on what Jay Powell says. And, you know, I think what markets are looking for at this point in time is really specificity over the magnitude and the extent of rate hikes that we're still going to be seeing from the Fed. Remember, they've already delivered more than 200 basis points of rate hikes this year alone. But, of course, there's expectation for a lot more, especially given pricing for where that terminal rate is going to be. Now, the problem is this, right? It sounds like a lot of the Fed officials that have spoken ahead of Jay Powell really have not been able to indicate any specific level. And we understand it is very, very difficult, of course. I think, you know, the Fed is still very much data dependent at this point. But, you know, this is kind of the gap between markets and policymakers, right? Markets really want that specific indication, at least, of where and how high rates are going to go. But I just don't know that Fed officials, Powell even,
Biden will be able to deliver that.
Right, yeah. Will he have anything concrete to add on that if they are being quite so data dependent? What about this debate around the terminal rate then, Christine, and how high it gets and how long it stays there for?
Yeah, absolutely, Anna. I mean, that really is very much the focal point at this point, right? I mean, I think this is what policymakers and markets can agree on, is that the terminal rate is potentially going to settle around 4% or perhaps slightly higher, just given where we are at now. And, you know, it hasn't been too long ago when that level was a whole percentage point lower at 3%. But this is how far we've come in terms of just the inflation levels that we've seen over the last couple of months. And so, yeah, I think there is very much the expectation that there is potential for that to get even higher and perhaps even overshoot. Again, it just depends on where it settles exactly. And yeah, again, the question is how long it's going to stay there for before they're going to have to start cutting.
All right, Bloomberg's Christine Aquino, thank you so much. And of course, we'll bring you live coverage of Powell's speech in Jackson Hole. That's at 10 a.m. New York time, 3 p.m. in London. Meanwhile, the average UK household will pay almost triple the price to heat their home this winter compared with a year ago. That's after the industry regulator Ofgem raised the energy cap on the back of soaring gas prices. I spoke with Utilitas CEO Bill Bullen yesterday about those rising energy costs.
Obviously, we go into the summer in the UK. Summer demand is much lower than in winter. Customers were going to really struggle going into this winter, but the idea of them going up to this new level of £3,500 just as winter demand is starting to pick up is absolutely horrendous.
Bloomberg energy reporter Todd Gillespie joins us now with more. Todd, what's the scale of this rise and how horrendous, as how he put it, could it get?
Yeah, I mean, I think it's something that's really unprecedented right now. We're essentially seeing a 178% increase based on the price that households would have paid last winter. Some people are talking about this as an 80% hike on April's rate. That really understates the issue because you have consumption that rises massively when households need to heat their homes during the winter. But the key thing that we're really looking at now, I mean, this estimate was priced in already into the way that people are thinking about inflation, the way that people are thinking about markets. But looking down the tracks, we're seeing another hike in January. We're going to see another hike in April, and both of those are going to be even higher based on current market prices than the one that we're going to see in October. The first estimate out this morning to surpass £7,000 in April came from consultancy Auxilione. So this is really something that is unsustainable for the UK economy without government help.
Right, and if it is unsustainable then, Todd, what could the government do? We are in the midst of a leadership contest, so the Conservative Party trying to find a new leader and therefore a new Prime Minister for the country.
Yeah, I mean, the Conservative Party is really kind of, some people are saying they're putting a bit of a spanner in the works in terms of putting in place emergency help right now because no new big policy decisions can be made until September the 5th when we're expecting a new Prime Minister to be installed. Liz Truss has said this morning that, she is aware of the scale of this problem. The Chancellor at the moment is saying that they're working flat out to, prepare options for people. But realistically, whatever it takes, we're going to be seeing anything from freezing bills, which the Labour Party is proposing, a lot of the opposition parties are proposing, which is going to cost in the tens of billions of pounds, to further handouts for households. More suppliers are calling for a £100 billion deficit fund, which could help spread prices over the next couple of years. All of these options will cost the government a lot of money, but then again, you're also talking about how we're going to smooth inflation potentially, because this shock that's coming in October is going to be one of the biggest sudden shocks to household expenditure that the UK has really ever had in recent history.
All right, Todd Gillespie, thank you so much. Now, from political issues in the UK to politics here in the U.S., President Biden kicked off his midterm campaign effort yesterday with a rally in suburban Maryland, testing his message ahead of what White House aides say will be an active 2 months of touting achievements and aiding Democratic candidates.
So I want to be crystal clear about what's on the ballot this year. Your right to choose is on the ballot this year. Is on the ballot. The safety of your kids from gun violence is on the ballot. And it's not hyperbole. The very survival of our planet is on the ballot.
Emily Wilkins, Bloomberg government reporter, joins us now with more from D.C. Emily, how is this message resonating with voters? Is there a sense that the Democratic tide is shifting a bit as we get closer to November?
Kaylee, there is a sense in D.C. that the tide is shifting. Remember, the projections at this point are that these midterms are going to be great for Republicans. They have historical precedent, they have redistricting, they have the high inflation that they can really go ahead and criticize Democrats for. But at this point, Democrats are actually starting to feel better. They're seeing inflation level off. They're seeing gas prices come down. They were able to pass their major initiatives through Congress, and they had a really key victory in a special election in New York this year. So really, Democrats are feeling very good right now. President Biden is feeling very good right now. He still is having trouble with his approval ratings. They're currently at about 41%, according to an aggregate of polls compiled by 538. That is slightly up from where he was in July, but that's not particularly high right now. And it could really impact a lot of candidates down the ballot as far as how folks see Democrats at a national level. You've already seen a number of Democratic candidates begin to really distance themselves from President Biden, and he even joked last night that, he would either campaign for or against senators, depending on what would help them the most. So you see that confidence, but at the same point, it'll be very interesting to see how this plays into the races for the House and for the Senate.
Well, Emily, let's talk about the other side of the aisle, specifically President Trump, as he deals with the warrant and the affidavit dealing with the search of his Mar-a-Lago home. What is the latest on those developments?
So yesterday, we did hear a federal judge say that certain parts of that affidavit could be made public. The Justice Department did request some redactions. They want to protect their current investigation, witnesses involved in that investigation. But we are expecting them to release that redacted affidavit at noon today. This has been a huge, explosive story, particularly in Trump world and among Republicans. There are lots of folks who are wondering exactly how deep this investigation goes, if it targets Trump directly, and if that could have an impact on both his potential run in 2024, as well as how voters generally see the Republicans and the Republican Party. So depending what is in that affidavit, certainly we're not going to see everything. A lot of it's going to be redacted, but we're going to be looking very, very closely for exactly why the Department of Justice and the FBI had that really unprecedented search of Trump's Mar-a-Lago earlier this month.
All right, Emily Wilkins of Bloomberg Government, thank you so much with your reporting from Washington. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with a deal that maybe won't actually happen. Bloomberg reporting that Merck's deal for Seagen apparently is reaching some difficulty over price, and as a result, may not actually happen. As a result, Seagen is down about 7% in pre-market trading. Merck is not yet trading. There's also some earnings news out there, including Affirm, which is a payments company, giving a disappointing revenue forecast for 2023. The company talking about the macroeconomic environment and headwinds there. And as a result, that stock is sinking 13% before the bell. It is a more positive story, though, for Workday, which is that HR application software company. It beat expectations, although the bar was pretty low, but nonetheless, the share is still getting rewarded for it this morning. It's up about 11% in early hours, Anna.
Coming up on the program then, Kaylee, we will be live from Jackson Hole. Yes, we know it is the middle of the night there, but we have a dedicated team. We will be joined by Julia Coronado, founder of Macro Policy Perspectives and a former Fed economist. Fantastic voice for us to hear from today then, as a lot of the focus is on Jackson Hole. And later today, we will hear from a string of Fed officials, including Patrick Harker, James Bullard, Loretta Mester, and Raphael Bostic, live from that symposium in Wyoming. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps to radical transformation.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Today, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage continues on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. Of course, all eyes are on Jackson Hole, but I would argue a little bit more emphasis on the market reaction after that, specifically as we look at financial conditions. For our radio audience, stick with me. We're looking at a chart here of the Financial Conditions Index, and of course, you can see that as we go into kind of negative territory starting in March, really on the onset of the war in Ukraine, well, it has continued to go into negative territory, but it is still higher than when tightening first began. So what's important to note here is that on the one hand, it's a concern because it's saying, well, is the Federal Reserve's kind of moves when it comes to quantitative tightening and interest rate hikes really working in terms of pulling back on some of that stimulus in the economy? On the other hand, is it a sign that the markets are actually able to digest what the Federal Reserve is serving them on a silver platter? Let's ask Noor Al-Ali, Bloomberg Markets live editor. She joins us now from London. We are thrilled to have her back on the show, by the way. Noor, thank you for joining us. Let me put that question to you. How big of a concern is it that financial conditions are looser as the Federal Reserve gets tighter and tighter?
Well, if you want the answers, you'll get them from Esther George. We've been hearing a lot of remarks from her recently. They've been recorded this week, and she clearly said they want financial conditions to tighten along the rate path in order for them to loosen up that tightening cycle. Obviously, the hawkish Fed speakers that we've had, from George to Bostic and Bullard, are paving the way for a very hawkish statement that's pretty much priced in later today from Powell.
Good morning to you, Noor. In terms of what we hear from Powell, there does seem to be certainly a lot of the preamble's been hawkish. We've heard a lot of hawkish commentary of late from the Fed very broadly. Is there room then for a dovish surprise?
Oh, yeah, absolutely. I mean, that's basically what we're primed for. You did see, though, yesterday, even as, that hawkish commentary was coming out of those Fed speakers, markets were pretty much unchanged, as though they've fully priced in that hawkishness. However, there is room for that dovishness to fully surprise. But we do know historically that Jackson Hole is not really about that forward guidance. It's more about economic research. So it is about what the market is willing to interpret from the Fed and what Powell's saying rather than what Powell would say.
Okay, and you will be able to, of course, hear the man himself later on Bloomberg TV. Noor Al-Ali of Bloomberg Markets Live, thank you very much. And for more market analysis, check out Markets Live Go, MLIV Go. That is the function to use for the Markets Live blog on the terminal. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Curdy Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. Germany is considering restricting the companies able to benefit from a new gas levy to those that really need the help. The government has faced scrutiny following an outcry over soaring profits at some energy companies. Germany initiated the plan over concerns of failures of gas companies would trigger wide disruption in energy deliveries to Europe's biggest economy. A buyout group led by KKR has pulled its $14 billion all-cash bid for Ramsay Health Care. It comes a day after the operator of Australia's largest network of private hospitals said it would not further engage on an alternative cash and shares proposal. The Sydney-based company released a statement confirming a Bloomberg News report. It will work with KKR Group to see if it can improve its offer. Blackstone is the latest institutional investor to back away from an overheated housing market. Home Partners of America, the single-family landlord owned by Blackstone, says it will stop buying homes in 38 U.S. cities starting next month. The company cites home price growth, market demand, and increasing regulations as factors in its decision. Home Partners operates in more than 80 markets. And T-Mobile is teaming up with Elon Musk's SpaceX to offer wireless phone service in remote parts of the U.S. where coverage is spotty. Musk and T-Mobile CEO Mike Sievert announced the partnership at SpaceX's Starbase in Texas. Musk says the satellite-based service will work even during hurricanes and natural disasters. Coming up, we will beat the drum to Jackson Hole with Chairman Powell due at 10 a.m. Eastern Time. We'll get the take from Wyoming with Julia Coronado, founder of Macro Policy Perspectives and a former Fed economist.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Countdown to Powell. The Fed chair will be under pressure to hit all the right notes in today's Jackson Hole speech, as some of his colleagues stress the need to move onwards and upwards with rates. UK regulator Ofgem triples the price of winter for many households with a hike in the domestic price cap, whilst warning more hikes will come. And Biden shifts into campaign mode. The US president touts a string of legislative wins and urges voters at a rally in Maryland to protect those policies. I'm Anna Edwards in London with Kriti Gupta and Kaylee Limes in New York. Matt Miller is off today. And Kriti, we're still waiting for Jackson Hole. Today we hear from Jerome Powell.
Waiting with, I had to say it, not a ton of action, at least in the pre-markets when you're looking at it from a macro perspective. S&P futures, well, they're kind of where we left them about 30 minutes ago. You are seeing them trade on a little bit of a down note, though, down about 0.3%. And it's a similar story in the 10-year yield as well. 307 on the 10-year, yields up to the tune of about 5 basis points. The dollar really unchanged once again. Anna, I think when we're talking about some of these moves, there really are just perhaps retracements and reversals from some of the action that we saw yesterday in the market as well. The S&P 500 rallied 1.4%, only natural to see a little bit of a pullback today. Similar story for yields. Yields came down quite a bit yesterday. Yields are reversing in the other direction today. So Kaylee, when we're talking about the macro picture, it doesn't seem like there's a ton of real direction, a ton of messaging, at least in the pre-market macro story.
Yeah, I'm sure it'll be a very different story 5 hours from now when Chairman Powell has wrapped up his speech, Kriti. I will say, while it seems pretty calm on the surface level, there is more movement happening beneath the surface of the equity market. A lot of movers out there in pre-market trading, including Dell, which reported after the bell yesterday. The quarter actually was pretty solid. Where the negativity is coming in is from the language from company executives themselves, talking about how customer behavior is getting more cautious, warning of potentially a softer environment going forward, and that is why the stock is down 4.3%, and it's dragging on shares of HP as well. They're down a little more than 2%. You also have some maybe not so much merger action. It is in fact actually Bloomberg reporting that deals talks have stalled between Merck and Seagen. It would have been Merck's biggest deal in about a decade with that cancer maker, but apparently there is a dispute over price at the moment, which is why those talks have stalled. So as a result, Seagen is down about 7%. We'll keep an eye on Merck once it begins trading in early hours, Anna.
I also have some M&A to talk about. More on that in just a moment. Kaylee, we'll start with the big picture on markets then. The Stocks Europe 600 down by 0.3%, and that's despite the fact we've seen gas prices pulling back a little bit from their most recent highs. That has been something that's boosted risk appetite, but not so much today. And we're just waiting really for Jackson Hole, but a little bit more negative actually than we were just half an hour ago. A few stock-specific stories for you. Relics, the publisher over in the United States, some concerns about changes to the rules around federally funded research, and that's got some analysts concerned about the ability to monetize that stock down by 3.4%. And in fact, the media sector, the worst performing here in Europe, so keep an eye on that stateside. Sanofi in the drug space, some speculation about maybe levels of payout to do with their antacid medicines. Maybe they won't be as much as maybe some analysts had anticipated previously. This all to do with some tentative rulings made by a judge over in Florida. And Micro Focus International, this is a FTSE 250 listed software business here in the UK. And this is the M&A I was talking about, Kaylee, up by 93%, 92.5% as a Canadian bidder steps in for this company.
Massive move for that stock, Anna. But let's turn back to the broader macro picture because the annual Jackson Hole Symposium is underway in Wyoming and markets are bracing for a highly anticipated speech by Fed Chairman Jay Powell. For a bit of color and context surrounding the symposium and a glimpse at a cowboy hat, Bloomberg's Michael McKee filed this report.
The Fed Chair's speech is the main event on Friday. Thursday, the talk of the conference was liquidity, but not the Wall Street kind. A massive storm hit Grand Teton National Park, flooding the roads and blowing down the TV tents, and creating its own inverted yield curve. Jay Powell's speech may not have an impact on the markets quite as dramatic, as investors have already priced in a hawkish message. Even if he says nothing new, they will probably take it that way. Meanwhile, we've had requests for a sequel to our history lesson on how the Federal Reserve ended up here. How did Grand Teton become a national park? A higher power took care of the mountains, scientists think about 2.2 billion years ago. Fast forward to 1929, and a small portion of this area became a national park. And then came John D. Rockefeller. He was so enchanted with the area, he basically bought almost all the land between here and the town of Jackson. And in 1943, he donated 43,000 acres to add to the national park. Now, this is where the deer and the antelope play. Grand Teton and Yellowstone to the north are also home to bison and elk. And once a year, in late August, you can spot central bankers in the wild here in Grand Teton. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Another great report from Mike. Well, joining us now live from Jackson Hole, yes, at 3:30 in the morning, is Julia Coronado, founder of Macro Policy Perspectives and a former Fed economist. So, Julia, many, many thanks to you for waking up at this hour to join us. Chairman Powell on the podium less than 5 hours from now. What are you expecting him to say?
Well, I think as Michael laid out, he's going to say a lot of the same thing he's been saying, which is that the job of restoring price stability is far from done, that they expect to be continuing to raise rates for a while, well into restrictive territory, where restrictive is means to them that rates are above long-run rates. So we're kind of at their long-run estimate of 2.5. But in an inflationary environment, that's not neutral. So they're going to keep going. I don't think he's going to give us a strong tell about what they're going to do in September. There's still data to get between now and then, very important data. And so I think he's just going to reiterate the same message. I think the theme of the conference, which is, revisiting constraints on policy and the economy, he may cite that, the Fed has been disappointed again and again on the supply side of the economy, and they have to be ready to calibrate accordingly. If the supply side doesn't improve, doesn't yield some of the relief that we've been expecting, then they'll have to keep going. But at the same time, I think the core message right now is data dependency. I think it's been a humbling year for the Fed. I don't think he's going to be pounding the table that he knows exactly where they're going. I think he says they're going to feel their way there.
But Julia, if he isn't very firm in saying that they know where they're going and that that's going in a hawkish direction, does that not just fuel potentially what we have seen in recent weeks and months, which is that financial conditions have actually gotten easier as the Fed has tightened? Why would he not need to push back aggressively against that?
Well, it's a great question, and he may in fact push back somewhat and stress that they have great confidence that the direction of travel is higher rates, which I do think they do have that confidence. So we may get a little bit of that. But if you look at the rate path that's priced into markets, it's not that out of line with the Fed's own sort of baseline rate path. And what we're going to see very likely if the higher rates start taking a toll is that we're going to see the flow of economic data, the flow of profits. You were just citing some profit warnings. You know, that's going to tighten financial conditions in addition to the rate path itself. So, you know, earlier on in the year when the Fed was at 0 and we hadn't started QT, you know, they really had to pound the table to get that message into financial conditions. Now we've got tighter policy. We've got a housing market with home sales down, you know, 30% on the year. You know, we've got some signs that the tightening is taking in effect. So, you know, data dependence means you're going to follow the data. And I think one of the lessons of last year is if the data are, in fact, continue to be inflationary, then absolutely they're going to go where they need to go to address that. At the same time, you know, if the global economy is in free fall, they'll respond to that too. So, you know, how the market is going to take that message and how hard he pounds the table on the bias towards raising rates sooner rather than later, you know, we'll find out in a few hours. You know, I think he's been saying the same thing, yet markets have sort of pivoted. He hasn't pivoted, markets have pivoted. So we'll see what he does with that.
Well, part of that pivot, Julia, is also the fact that perhaps they're able to digest some of these market hikes at a time when I think a lot of investors particularly are worried about liquidity and are worried about market plumbing. I'm curious if the Federal Reserve should even be concerned about the liquidity story, or is this kind of, to some extent, interpreted as, well, we can give the markets perhaps a little bit more of a tougher stance because they can handle it?
Yeah, I mean, there are liquidity issues. None of them have been acute so far, but I think the Fed is aware of those. And I think the fact that they're doing QT at the same time as raising interest rates adds a dimension of uncertainty to how far they'll have to go and how this will play out, because balance sheet policy and liquidity can often be very nonlinear. And actually, President George cited that yesterday, that, you know, she actually seems to prefer to move forward at a 50 basis point pace because they're doing QT and because those impacts can come in rather suddenly. And, you know, that's a dimension of tightening through global markets. And I think it's really important also to note that the easing in financial conditions has been mostly a U.S. phenomenon. Global financial conditions aren't easing in the same extent, and global economic indicators are certainly weaker than the U.S. And while the Fed is, you know, focused on the U.S., that does matter as well. Some of the easing in U.S. relative to global financial conditions can sometimes be almost a flight to safety. You know, when the environment is very uncertain, people hold dollar assets, and the U.S. economy has been the outperformer. So, you know, I think that Chair Powell and the FOMC have to bring all of that to the table when they make the decision in September.
Julia, I'm so glad you brought in that international perspective, because this week alone, we've also heard a lot more stimulus coming out of China, and at the same time, perhaps a little bit more of a hawkish stance on the ECB, just as they perhaps face a recession coming into at the end of the year. I'm curious about that policy divergence, though, between the United States and China. Is that something economists should be worried about when it comes to the global economy?
Yeah, I mean, I think we've been seeing some very significant moves in currency. Those are things that can add to that kind of global illiquidity, depending on how these central banks, you know, balance against each other. So I don't think that that's the primary determinant of policy, but I do think, again, that it is on the table for discussion as, you know, an element of the environment. The global economy is slowing in a very pronounced fashion. Other central bankers are doing some of the work, as you noted, in Europe. And the European trade-offs are far worse than what the Fed faces. Even though U.S. inflation is higher, the U.S. economy is a lot more resilient. The Fed can have confidence, you know, kind of marching forward with higher rates with the job market that we've got. You know, the trade-offs are slightly better, although nobody is facing good trade-offs, not China, not Europe, not the U.S.
Yeah, difficult situations globally, but for different reasons. Julia, do you think that we will get any reflections from the Fed about how far we've traveled in our understanding of inflation and what has been wrong in the Fed and other central banks' assessments of where inflation has been? Because you mentioned in your notes ahead of our conversation that it was Jackson Hole last year where Jerome Powell set out 5 reasons why he expected inflation to moderate. Do you think we need to reflect on that?
Yep. Yeah, absolutely. And look, Chair Powell is a man that is reflective, and he's very forthcoming about that. So I think he will say, you know, we need to be humble, and we need to, you know, follow the data where it goes. And which is why I don't expect him necessarily to pound the table that he knows exactly where we're going, other than to say, you know, you can trust us. We're going to restore price stability, even if it comes with economic pain. And, you know, remember, we don't get Q&A with Chair Powell, so we won't get to, like, you know, press the nuances of the speech. But I do think there will be a lot of elements of humility that, you know, again, to the conference theme of constraints, you know, the global economy is operating under even, you know, a lot of constraints that we didn't expect to last, and they've lasted. And that's certainly salient information for the central bank targeting inflation.
We talked about China and the risks there. We've also mentioned in passing some of the challenges that Europe faces, Julia. I know this is a US event, and as you've pointed out, the policy focus is going to be on the United States. But how concerned do you think the economic community that's gathered there, how concerned are they going to be about the European growth story over the winter and all the energy challenges that it faces?
I can tell you there's a lot of conversations about Europe here, and there are a lot of European policymakers, and we've got a couple of panels. I mean, you know, Chair Powell is the main event, but remember, there's a couple of panels with European ECB policymakers today and tomorrow. So we may get some, you know, information from the European side and from the European policymakers here as well. And I think Europe is very much in focus as, you know, the epicenter of both economic weakness and, you know, inflationary pressures that are coming from the war situation that aren't going to abate anytime soon. And it's going to be a tough winter for Europe.
Julia, thank you very much for your time. We appreciate it, especially as it is so early there in Jackson Hole. Julia Coronado of Macro Policy Perspectives, thank you so much for joining us. And indeed, as she was pointing out, there will be some European voices speaking over the weekend. We set our clocks for early FX trade in Australia then perhaps on Monday morning. Coming up on the programme, we will talk to Antoine Bouvet, Senior Rate Strategist at ING. What will Antoine be watching for today? This is Bloomberg.
Stronger that moment that you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
So I think what you're going to see is more strength in the real economy than in the financial economy. The financial economy converged to the real economy, and that's a big move in financial assets, a big downward move in financial assets in total. To some extent, that'll be in bond markets. To some extent, that'll be in the equity market. But in aggregate, let's say asset markets declining at something like the 20-25% decline from here.
That was Greg Jensen, Co-Chief Investments Officer at Bridgewater Associates, speaking with Bloomberg yesterday, speaking with Kaylee Limes, I think. Joining us now is Antoine Bouvet, Senior Rate Strategist at ING. Antoine, very nice to speak to you. So we're preparing for Jackson Hole, of course, but he was talking there, Greg Jensen was talking about the effect of QT, and our last guest was actually talking about how QT adds uncertainty to this rate hiking cycle. Is that something we need to keep in mind as we brace to hear Powell later on? Is it going to be something that he returns to?
I don't think this is something necessarily going to return to, but we should pay attention to it. Ultimately, quantitative tightening in that magnitude is something unprecedented, and even the Fed doesn't know how it's going to play out and how it's going to interact with hikes. So that's one more reason for them to be a bit more cautious than if this wasn't happening.
Do you think we will be any the wiser by Monday, Antoine, about whether we see a Fed that hikes and then cuts or hikes and then holds?
Well, I think at the margin of Jackson Hole, we've heard a lot already from various speakers, and what they told us.
Hawkish warm-up acts.
Exactly, yeah. So first off, I don't think there's a lot more than Powell can say on this sort of micromanagement of the curve. Secondly, I thought the Fed was supposed to have given up on forward guidance, and here they are giving us, ideas of what interest rates are going to be 1 year down the line. That Fed is backward-looking. They're basing their decisions on realized inflation. It's completely rational for them to tell us, financial conditions don't ease, rates will go up, and so on and so forth. But that doesn't say anything about the decisions they will take 1 year down the line, which is exactly what the curve is pricing. So, I think they've had some effects on the curve. Rates have risen. There is not a whole lot they can say to push rates up. But one of these things could be a direct reference to financial conditions. I think the market will take that as, another hawkish barb. Another one would be perhaps a bit dramatic, but a hint that inflation dynamics have changed and that the Fed needs to act more forcefully.
Okay. Antoine, I take your point about forward guidance. It's almost like it died, but then was immediately reborn, just maybe in a different form. You just said there that there's not going to be much that can push rates higher from here that the Fed could say. Do you think we've already seen the peak at the short end?
At the short end, not necessarily. At the back end, yes, 3.5% 10-year treasuries. I think the peak's in, and I would be surprised if we test it. Now, it's not really far. The thing I would say, though, is I wouldn't really overstate the importance of Powell's speech in the direction of treasuries. I think the jobs report next week and the CPI the following week is really what's going to dictate performance in treasuries over the next few weeks.
Yeah, there's a lot of data between now and when they actually make their next rate decision on September 21st, so that's a very fair point. You said we're maybe not done at the short end, even if we've already seen the peak in the long end. How much deeper do you think curve inversion can go?
Through 50 basis points, if you look at the two-stance treasuries. It will depend a lot on how quickly the recession fears, especially in Europe, hit home. Ultimately, this is something that's going to, put demand back towards the back end of the curve. This is also, what's going to help the market realize that ultimately, perhaps not in 2023, but in 2024, will allow the Fed to cut rates, and this is going to be beneficial for treasuries. So that inversion could go through 50 basis points. I think so.
Antoine, what is the Treasury market really being driven by? I mean, obviously the answer is the Federal Reserve naturally, but I'm curious in terms of the cross-asset correlations here, what are they actually perhaps leading and lagging?
Yeah, I think you're making a very good point, actually. We should put the jump of in U.S. Treasuries above 3% in the context of, very sizable rebound in the stock market and this environment. investors think, well, perhaps we've seen the worst in terms of tightening. Let's pile in risk assets rather than U.S. Treasuries. So if we see another correction in risk assets, especially in the stock market, due to the realization that we're heading into recession, that this is going to be negative for risk assets, then this is what's going to drive Treasuries back lower. So more of a lagging indicator, I would think, in that case.
A lagging indicator, but then again, I'm curious about the bull case for Treasuries. It kind of felt like, as we were talking about a very hawkish Federal Reserve, the bull case for Treasuries that has, I want to say, been driving the market for the last 10 years seemed to kind of collapse, but as Kayleigh says, perhaps reborn again in another form. How quickly does that bull case for Treasuries become the base case for a lot of investors as we talk about recessions in other parts of the world?
Quite frankly, I think it's going to be closer to the end of the year. So we have a forecast of 2% for 10-year Treasuries around in the first half of 2023. That bull case centers around inflation falling back towards target, and it's clearly not going to be back at 2% in the middle of 2023, but it will be on its way there. And remember that some components of CPI, the housing ones, are led by house prices effectively, and the housing markets is falling off a cliff. Fast forward to the middle of 2023, inflation will be much closer to target, but not at target. But crucially, the Fed will be in a position to forecast inflation going back to target, and this is what will allow them to cut.
Can I pivot to Europe, Antoine, in our conversation? And in terms of European bond markets, how do you think we should prepare for fiscal announcements and fiscal generosity from European governments? Because there's a lot of talk of it, even where we haven't seen the detail. You kind of expect that is maybe coming over the winter. Is this something that bond markets would welcome because it secures European economies to some extent? Or will this just be something that worries bond markets because of debt levels?
I don't think this is debt level, strictly speaking, that does worry them. I think one of the fears, and we've seen that in the gilt market recently, is the interplay between fiscal and monetary policy. We've had some warning by the Bank of England, for example, that too generous fiscal package to support households would force them to hike rates more. So calibrating this fiscal policy will be very important. Yes, you're right, there will be more debt issuance, and in the short term, in a market that is illiquid and very nervous, this can have a short-term impact. But more profoundly, what will the Bank of England do, and what would the ECB do when they see these fiscal support packages? My view is they should be relatively generous to shield the most, let's say, vulnerable households. But this is not enough to shift my expectations on monetary policy.
So it has to be quite targeted?
Yes.
Yeah, okay.
Well, of course, we talk about monetary policy in the UK and Europe, and there's a question of whether or not anything they do, even if it is aggressive rate hiking, can actually support the pound or the euro. It just seems to be that it is dollar strength, full stop, for the time being. Antoine, how does that feed back through to the rates market for you?
So it's a problem, clearly, especially in the UK, imported inflation, and so the weakness of cable is a problem, but also in the Eurozone, the weakness of the euro means higher import prices. I share your view. I don't think central banks, there's a lot central banks can do. Ultimately, of course, pushing the reasoning to an extreme, they could, if they put rates to very extreme levels, but to levels that aren't realistic. So for now, dollar strength and weaknesses in European currencies, and unfortunately, the reality.
Antoine, thank you very much. Thanks for your time. Good to speak to you. Antoine Bouvet of ING joining us to preview, to help set us up then, Kayleigh, for Jackson Hole and what we hear from Jerome Powell. I thought it was really interesting, though, how we were just talking there about guidance and about how forward guidance had supposedly gone and it wasn't useful, very data dependent now, central banks around the world, not just hearing that from the Fed, of course, Kayleigh, but elsewhere. Maybe it's the media's fault. Maybe we keep asking them too many questions.
Yeah, you could probably blame a lot of things on us, Anna, but I think markets really will be looking for something in the form of guidance. And Creedy was talking about earlier how the market is expecting hawkishness. We have seen that being priced in leading up to this. So what exactly is Chairman Powell going to deliver at 10 a.m. Eastern? Can he take this market by surprise?
Yeah, absolutely. Right, later today, we will hear from a string of Fed officials, including Patrick Harker, James Bullard, Loretta Mester, and Raphael Bostic. All of that live from Jackson Hole. Also, of course, Fed Chair Jerome Powell speaks in Jackson Hole at 10 a.m. at New York time, 3 p.m. in London. Stay with us for full coverage of Powell's speech. This is Bloomberg.
should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in the new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I worry that core inflation is going to prove more sticky than the Fed anticipates right now.
I do think the Fed is going to push back on all this chatter about pivots.
The Fed just can't wait to let inflation work itself out.
I think the Fed solution is slow the economy down. It's growing faster than can possibly be sustained long term.
We have to get interest rates higher to slow down demand and bring inflation back to our target.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
How did we end up in a field at 4 a.m. local time for a bunch of academics? How did that happen?
It's called Jackson Hole. I mean,
Jackson Hole? Live from Jackson Hole.
We're thrilled to be here.
Good morning, good morning. We're so thrilled. 40 degrees, is that 40 degrees?
I was out here at 1 a.m. looking at the stars. You could almost see the Andromeda Galaxy. I looked over, there was Chairman Powell with his set of binoculars.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures down about 0.4%. TK, we know the main event. It's several hours away.
It's here and it's exciting. You can feel the anticipation here. All the presidents are here, all the various American economists, and a good foreign contingent as well. I mentioned Chairman Powell with the binoculars looking up at Cassiopeia and Andromeda. John, he's got binoculars out trying to look at the data on the way to the September meeting.
Did you rehearse that this morning?
That's why he was up at 3 a.m. Script early on.
I'm sure he did. Let's talk about the Fed speech we've had so far. Just about. We've heard from President Bullard in the last couple of days. He's talked about front-loading, Lisa. We've heard that a few times. We'll catch up with President Harker a little bit later this morning. He's talking about the raise and hold. Yeah. I just wonder how much we hear about raise and hold over the next 12 hours.
Well, raise to what and hold for how long? And this actually matters because they could hold for 2 months and then they're in coherence with what the market is saying. They hold for 2 years and all of a sudden we're getting to a very different Jan Hatzius kind of territory. Yesterday, Savita Subramanian of Bank of America was saying the market's priced for holding for 2 years at 3.5%. Is that true? Do we really hear that from anyone else?
Reasons to get bullish. What does Savita say? Pretty thin.
Yeah,
pretty thin.
Pretty thin at this point, given the fact that any rally in equities right now will be met with high skepticism from Fed officials themselves.
The point that Mike Wilson made earlier this week as well, Tom, it's not just about rates, it's about QT too. If we're going to have some kind of balance sheet reduction, I think that's what we need to talk about with these Fed officials. Yeah. It's all well and good talking about raising interest rates. I also want to hear what you think the balance sheet reduction is going to achieve and what that means for how many interest rate hikes you think we have to come.
I question we'll hear that in the speech. I don't think so. The media is so fixated on the interest rate game and ballet. What I found here that surprised me is how everybody's going to where, frankly, the three of us have been talking for months, which is the duration of this. And, you know, you wonder, forward guidance, dead. data dependency dead is maybe the new phrase front-loading from James Bullard.
And we're going to hear that from more Fed officials. Let's go through the price action for you to get you started. Equity futures this morning down about 1/3% on the S&P 500. Not too much drama. Down on the session, down on the week. Looking at the bond market, yields higher by 5 basis points on a 10-year to 3.74%, 3.074% before you get too worried. On a 2-year yield, getting close to 3.40 all over again, Bramo.
Yeah.
Yields up by about a basis point to 3.38 on twos.
With the expectation of a hawkish tilt to the speech, just to give you a sense of what we're expecting today, I know you're going to talk about the toxic brew of hawkish tilt. We're going to be speaking with a whole host of these incredible Fed officials, or at least talking about what their incredible views are. Patrick Harker, Jim Bullard, as well as Raphael Bostic, all joining Bloomberg Surveillance in the extended version in that drumbeat to the 10 a.m. Eastern Jay Powell speech. It is the first ever to bring people inside the room since they've been doing this meeting in 1982. That is the first time that the public has gotten this view. Well, but it's actually really interesting to figure out why now, right? And we can discuss that. 8:30 a.m. we get U.S. personal spending and as well as core PCE deflator. You guys are laughing at me.
Oh, it's the early morning, Bramo.
Carry on.
That wasn't that bad.
Just lean back here.
Core PCE. I'm curious to see how much it comes down. Where do we get comfortable with PCE coming down? Because it has dipped lower, but does 4.8% cut it? Not really. And then remember when we would have been saying this was University of Michigan sentiment Friday? Well, what happened to that? Does anyone care anymore? We're getting that at 10 a.m. Eastern. At the same time that we get a Jay Powell speech. Who's going to care?
Can we speak now? Is that okay?
It
just felt like you didn't want us to talk at that point. We can talk about it later, but I wanted to talk about it.
Okay, go ahead.
I think it's fascinating that they're finally lifting the veil.
I would agree.
Why? Because their decisions are so consequential for this whole country. I think it's about time. It's been way too long.
I would agree, and I think that that's a question to ask Fed officials. Is this the beginning of a new dawn of transparency that's necessary given some of the pushback that they've gotten from the public that's enraged by the inflation they're feeling?
Tom would like to hear less. Fewer Fed officials speaking. I know that's how you feel about it.
This is a debate, and I talked to President George of Kansas City. John, let's compare this. We got our guest is so important. I really think we've got to stagger to our guest. But one of the things we should talk of later is how much communication is too much.
Steve Major joins us now, the Global Head of Fixed Income Research at HSBC. Steve, let's start here. Your expectations for Chairman Powell a little bit later this morning.
Well, good morning to all of you. I haven't got a great expectation. I'm much more interested in the speeches and the panels, the round tables that are going to go on through the weekend, because Jackson Hole is about these more serious, longer-run secular forces. And if you look at some of the speeches and discussions that are coming, they're much more interesting than any kind of hint on the next policy move. So, bonds are about longer-run equilibrium. The FX spot market might hang on every word of Powell's speech, but the bond market's already made up its mind. The curve is inverted. Rates are pushing to high threes in the near term. But the bond market also considers the fact that in a few years' time, policy rates will be back down at 2.5. And that's how valuations are formed.
Steve Major, do you still stand by the idea that bonds will be supported, price up, yield lower, as you've said courageously for the last 5 years?
Well, yeah, nothing has really changed, and the central banks gathering in Jackson Hole can't change those secular forces. They can recognize them. These are the constraints that they've met to discuss: constraints on policy, constraints on economies. And what are those constraints? Well, it's the debt overhang, it's the aging populations, it's the supply side shocks, it's education. I mean, can central banks educate our children or make old people younger? The answer to both questions is no, of course. So they are customers of the longer run equilibrium just as much as we are. So they can do their best with the near-term policy rate, but the bond market looks through it. And the bond market is not wrong with yields at 3. If the Fed was to reach 4 but end up at 2, well, the average of 4 and 2, guys, is 3. So the bond market's not wrong today. And I would suggest that in the next few years, we will see lower yields, not higher yields.
So, Stephen Major, I will ask some of the Fed officials who we're speaking to later today whether they can educate my children or make me younger, and we'll see what they say. There is this counter-argument to what you're saying, and Jan Hatzius was pushing back and saying, actually, this economy, as debt-sensitive as it is and as laden in obligations as it is not as interest rate sensitive as many people think because of the other side of the equation, the benefits that a lot of the income receivers get and the ability to spend. How do you push back against that thought, which is frankly growing at the likes of PIMCO and Capital Group, where they say that this inflation is here to stay at a longer and higher pace than we've seen in the past decade?
It's a fair point that someone has to receive the interest or the coupons that are paid. But if you overlay the distribution of income and wealth to the savings rate, for example, and to the debt stock, you'll see a very, very stark picture. The people that are saving don't need the money. The people that pay the interest rate can't afford it. And I'll tell you, the big borrowers here have been the lower paid households and governments, and that's a kind of global phenomenon. Governments are constrained. They're constrained because rates can't go up that much higher than the average coupon on the Fed's balance sheet, for example. And so they've got this closing jaws between the income they receive on the bonds they bought and the rate they pay out to fund them. And then there's the households, the poorer households. They really are feeling the pinch from higher energy prices, food prices, higher mortgage rates, etc. So I think that on aggregate, there may be an argument that you could balance the income and expense. But when you look at the distribution of wealth and income, it's a pretty stark picture.
Steve, I want to squeeze this in and just keep it super, super simple. Have we seen the highs of the year on the 10-year?
We saw them in June. So we saw the 10-year push.
Is that the end of it?
That was it. So we saw the 10-year yield hit 3.5 on a 75 basis point hike in June, another 75 basis point hike in July, and we were down towards 250. We had a 100 basis point range almost between two meetings. The market seems to be hanging on the neutrality question. I think Mr. Powell raised the idea of neutrality. He wasn't wrong. When the forwards are around 3% and flat across the curve, and the Fed is guiding to a longer run equilibrium of 2.5, and by the way, James Bullard, who you mentioned, has got a longer run dot of 2.0. It'd be nice to know if he's changed that. He may be pushing for 4% near term, but his longer run dot was 2.0. So you know, I don't think the Fed chair was wrong when he said we're close to neutrality. It depends on your definition.
Well, Steve, we're going to have that conversation, potentially with Jim Bullard a little bit later this morning. Steve, also to catch up. Steve Major there of HSBC. So Steve thinks that was it, the high, close to 340 back in the middle of June. Bramo, what do you think of that?
I think that that's pretty consistent with where Stephen Major has been, where he basically has been saying we're going back to a cyclical lower low when it comes to interest rates, when it comes to benchmark 10-year Treasury yields. And this is because of some of the structural changes. This is the big debate, though, here. Has that shifted in a time of deglobalization and higher commodity prices?
You mean a permanently higher shift in rates and inflation?
Correct. That is the real core question underpinning a lot of the discussions here.
No animal noises this morning, Tom.
I'm too cold to do. We're going to do them later. There's a cruise being sighted right now. I want to get this in real quickly. This is all about the elites. The shock of the morning is $7,700 US is the expected utility bill in the United Kingdom next year. 6,600 pounds. John, that is jaw-dropping.
Tripling, and we're going to discuss it in just a moment. Futures down 0.4% on the S&P 500 from Jackson Hole this morning. Good morning.
With news from around the world, with the first word, I'm Ritika Gupta. Ukrainian President Volodymyr Zelensky is reinforcing his call for Russian troops to withdraw from Europe's biggest nuclear power plant after damage to transmission lines in the occupied territory disrupted power supply. The president says Ukraine is trying to prevent a nuclear accident that could impact all of Europe. The plant was captured in March when Russian troops swept through southern Ukraine. The average UK household will pay almost triple the price to heat their home this winter compared with a year ago. That is after industry regulator Ofgem raised the energy price cap on the back of soaring gas prices, and it's expected to increase it even more in January as the UK competes with other nations for limited gas supplies. It's a jarring increase for millions already struggling to afford everyday essentials. Blackstone is the latest institutional investor to back away from an overheated housing market. Home Partners of America, the single-family landlord owned by Blackstone, says it will stop buying homes in 38 U.S. cities starting next month. The company says home price growth, market demand, and increasing regulations as factors in its decision. Home Partners operates in more than 80 markets. T-Mobile is teaming up with Elon Musk's SpaceX to offer wireless phone service in remote parts of the U.S., where coverage is spotty. Musk and T-Mobile CEO Mike Sievert announced the partnership at SpaceX's Starbase in Texas. Musk says the satellite-based service will work even during hurricanes and natural disasters that knock out traditional cell phone towers, and that it will ultimately save lives. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We're just 76 days away from the midterm election. 76 days. And to state the obvious, there's a lot at stake. We're at a serious moment in our nation's history. The MAGA Republicans don't just threaten our personal rights and economic security. They're a threat to our very democracy.
President of the United States, live from Jackson Hole, Wyoming. Good morning to you all. This is Bloomberg Surveillance alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Your equity market set up like this morning. Futures down about 0.4% on the S&P 500. Coming into that big address by the Fed Chair, Jay Powell. That's going to take place at about 8 a.m. local time, so 10 a.m. Eastern time, Tom, with yields a bit higher by 6 basis points at 3 points. Should we call it 3.1%? I think we can do that.
Yeah, I think we can do that.
3.1%.
But a real standstill, John, in the data right now. I see it within the VIX, which has basically been immovable at a 22 level for 2 days.
I don't think there's been a big move in the equity market this week. Slightly lower. I'd say the big move again, and we've talked about it all week, has been at the front end. Yields starting to climb higher once again, getting back towards the highs of the year.
Where's the 2-year? I haven't seen that.
Just
yet.
close to 340.
Okay,
in
so
around 340. So close to the highs of the year.
It is Jackson Hole, and of course we're aware of the weather. We do it for John Farrell always in centigrade degrees. 6 degrees of separation here this morning. Rather cold, but overarching the cold is everywhere you look, there is drought. Lisa Bramwitz has been leading on this. Emily Wilkins joins right now. Emily, the inflation that we have could be food. The food prices haven't moved yet. Is Washington, and for that matter, surveillance in New York, are they aware on the East Coast of the drought we're seeing right now across all of the Midwest and out into the Rocky Mountain states?
I mean, absolutely. That's a concern. The high prices at the grocery store are still a concern. Look, Democrats are taking a small sigh of relief right now that we saw inflation level off last month, but it is still high. And they still know that that's going to be a major problem for them. When I talk to folks who are campaigning, who are knocking door to door, they say that inflation consistently comes up as an issue. At the same point, Democrats are now feeling much more confident that they have other things to point to for voters, some of the legislation they've passed in the previous month, that the gas prices have come down, on abortion access. That's been a huge thing that's shown to be a really big winning issue for Democrats in the most recent special elections. So yes, Democrats still have to contend with high inflation. They got to be keeping an eye on what's going to be happening in the next couple of months as folks go to the polls, but they also see some other narratives that they can really put out there and try to win on to make sure that if there is a red wave in November, it's not nearly as big as was initially projected.
Those narratives are many right now. Which is the one, besides the abortion debate, that the Democrats can run with? Is it affidavits with black marks across the pages?
I mean, that one, it's such an interesting story. The whole search warrant, really unprecedented that the FBI carried out on Mar-a-Lago. We're going to be getting more information today in noon. The Department of Justice is going to be releasing a redacted version of that affidavit. We're going to learn a little bit more about the investigation. Now, exactly how much, it's not clear. Obviously, a lot of things have been redacted because the Justice Department wants to, protect certain parts of the investigation as it's ongoing. But that's really something that's driven a divide in the Republican Party right now, right at the point where they're supposed to be picking up momentum on the way to November. They now have to deal with Trump being back at the top of the party, headlines in the news, and that's not necessarily going to be beneficial for some of their down ballot candidates. They're also struggling right now with some particularly weak candidates showing weak polling in some really key Senate races. And so that's one thing that Republicans are struggling a bit with right now. I think for Democrats, they just can point to a number of things that they can say they've gotten done. They can point to that veterans bill. They can point to the infrastructure bill. They can point to the semiconductor funding bill. They can point to the bill that addressed health care and taxes. They just have a lot of different things that they can take back to voters and say, hey, we've done this. Exactly what they're going to be highlighting, that's really going to vary depending on where you're running, who your constituency is, how blue your district is. So you're going to see a variety of messages, but Democrats have a lot that they can pull from and really use.
Emily Wilkins down in D.C. Emily, thank you. The big game changer here. Where will we be in 12 months if we're sitting here again? if we see unemployment climbing for this Federal Reserve, and remember they've got that in their forecast into year-end, Lisa, they've got unemployment going back towards, say, 3.7% from 3.5. That's a major deal on the surface of things. But if we're sitting here in 12 months and unemployment is going the wrong way, but the politics in DC folded into an event like this, it's a very different picture.
Because then they can't raise interest rates to the same degree. They can't talk as cavalierly about imposing pain in the same way that they can now, simply because that will be the big pushback. But I also want to say, what I'm curious is here, how much do we get a discussion about how some of the fiscal spending has fueled the inflation and where that ties the hands of fiscal policymakers in the future to spend money to possibly stave off a depth of a recession going forward?
We asked this a couple of times, Tom, in the last couple of days. Will we see this dual mandate of this Federal Reserve in conflict by the end of the year? Unemployment going the wrong way, inflation still elevated, still sticky.
Yeah, and then the growth equation comes into it as well. I think what you may hear today is a partition of, as he spins good news, of the services versus goods. And to the point of where we are a year from now, so much of that, according to everything I read, is based on goods inflation. There's an assumption that service sector inflation will not come down. But goods inflation has every ability, given events, to come back to some form of disinflation or outright deflation. He may allude to that today.
Well, the retailers have been grappling with that over the last several months, Tom.
And the different selections of retailers is key.
I think one of the big standouts for me from Walmart a number of weeks ago, essentially saying that high-income Americans are now going to Walmart. Something's happening here that isn't really being captured in the data. There's something happening in the American economy at the moment when you see high-income Americans going to Walmart, when you see a stat like 1 in 6 American households delaying their utility bills. I would say that we're not exactly capturing that in the data when we're talking about a blowout jobs report, are we? There's something amiss here.
Well, and how much is it just a lagging indicator? How much is it this divergence between employment that still is hot because of a real disparity, a real shift in the labor market versus actual strength in the economy? How do they understand this and then cater to the weakness at the same time that they have to fight inflation? And this goes to your point about the dual mandate. When do they have to start talking more about that weakness, more about that downgrading of some of your purchases, and less about just simply fighting inflation?
How can you have weakness with 280 or 290,000 jobs modeled in the last 30 days?
It's a lagging indicator. That's what people say.
It's a lagging indicator, but the fact is, not only America, but we noticed yesterday the Irish Times, Ireland employment is booming. What's in the United Kingdom?
Tom, in the UK right now, they've got a tripling of their utility bills. And this is kind of the point. If you focus on the labour market, sure, let's focus on the labour market. Might say everything's okay. Throw in unemployment, right? Might say everything's okay. Great. Then look at CPI and look at where wages are. Very different picture. Yeah. And that's the problem. I think it's all well and good as looking at the labour market and unemployment and saying things are okay. When you look at the inflation picture and fold that into the labour market, you've got a very different understanding of what's happening in this economy.
Of course, the implication when you started this was how the politics fold into the moment at Jackson Hole. And that's also going to be a big discussion, right? The independence. And perhaps that's the reason, going back to, and we can talk about it now, this question of why they're holding it in such a public way now. They're trying to get their hands over the narrative.
You know the interview I'm looking forward to most? Jason Furman.
Oh, totally agree.
In the 9 o'clock hour, Tom.
An important interview. He's been very visible in the economics press in the last 24 hours on student loan.
We'll catch up with Sir Howard Davies of NatWest Group and the former Deputy Governor of the Bank of England as well. From Jackson Hole, this is Bloomberg.